Excited.
All right. Good morning, everybody. It's great to see folks. We're going to go ahead and ask our presenters to come on up, and we'll get started. We'll go ahead and start with brief committee introductions, starting with Senator Scherer on my right.
Good morning. I'm Bill Scherer. I'm State Senator from Senate District 1, which is Farmington.
Good morning, Mr. Chair and public. I'm State Senator David Gallegos from Eddy and Lee County. Beautiful area, nice facility. My granddaughter actually moved into a dorm here just this weekend, so I'm happily supporting New Mexico State. God bless y'all. Thank you.
Good morning, Mr. Chair and Mr. Vice Chair. I'm Senator Michael Padilla. I represent the southern portion of Bernalillo County in Senate District 14. Also serve as the Senate Majority Whip. Thank you. And thank you for having us, Las Cruces.
Good morning, Mr. Chair, of course, Vice Chair, to the members of the Legislative Finance Committee, staff, as they continue to go ahead and work diligently to ensure that we have. Okay, all right. State Senator Pete Campos, representing all the parts of 7 counties in northeastern New Mexico. But again, it's great to go ahead and be here. And I really want to go ahead and thank the work of the people here at the Convention Center under the leadership of Louis Garcia, who, if you get a chance to talk to him, boy, he has a lot of great stories to go ahead and share. And so that's what it's all about, how we build relationships, how we move forward. And as we listen to the revenue outlook today, what that's going to be looking like. So again, thank you very much, Mr. Chair.
Good morning. Thank you for letting us come down to New Mexico State and Las Cruces. We appreciate it. It's kind of my old stomping grounds. I'm Steve Lanier from District 2, just down the road, Farmington. Aztec, about 7.5 hours.
Thank you, Mr. Chair. Good morning. I'm Senator Nicole Tobiasen from District 21, Northeast Albuquerque.
Good morning, Mr. Chairman. Good to see you this morning. Thank you for having a meeting in Las Cruces next to New Mexico State University, our agriculture school, home of our Department of Agriculture. I am a farmer and a rancher from eastern New Mexico. My district is Curriquay, Union, and Harding. I appreciate you having this here today, and my name is Pat Woods. Thank you.
Good morning, Mr. Chairman. I was going to introduce him as Pat Woods, but he did remember. Good morning, everyone. I'm Senator Benny Shendo, Senate District 22 from Jemez Pueblo.
Morning, Mr. Chair. I'm State Rep Joy Garrett, west side of Bernalillo County in Albuquerque, home of Petroglyph National Monument.
Good morning, Mr. Chair. Good morning, fellow members. I'm Charlotte, and audience members. I'm Charlotte Little. I represent House District 68, which is in northwest Albuquerque. Thank you.
Hi, good morning. I'm Representative Sarah Silva, House District 53. Welcome to Las Cruces. I represent the East Mesa of Las Cruces, White Sands Missile Range, and Chaparral.
Good morning, everyone. Good morning, Mr. Chair. Mark Duncan. I represent San Juan County, Farmington area. Thank you.
Ours is working. Good morning. My name is Derek Lente. I come from Sandia, Pueblo. I'm proud to represent District 65 in the House of Representatives that includes parts of Rio Arriba County, San Juan County, and Sandoval County. Good morning.
Good morning, everybody. Representative Jack Chatfield, northeastern core of the state. I'm a rancher up there. I represent Colfax, Curry, Harding, Quay, San Miguel, and Union counties.
Good morning. I'm Representative Meredith Dixon from House District 20 in Southeast Albuquerque.
Good morning, everyone. I'm George Munoz. I represent Cibola, McKinley, and San Juan counties. It's nice to be in a place where it rains, because those of us, including Senator Scheer and Senator Lanier, have had no rain in the northwest corner of the state, and it's the driest I've ever seen it. So it was nice to see rain, and it was actually cooler here than it was in Gallup, New Mexico, where it's 50 in the morning already. So thank you, Mr. Chairman. Thank you for bringing us to Cruces and having us here.
Thank you very much. Thanks, everybody. My name is Nathan Small, represent House District 36. Really excited to see everybody here today. Grateful for our staff and the members all making it down. Really excited. We're going to have some fairly full days, so we're going to dive in, really manage the time, make sure as we have questions to dive into those. If there's things that we're sort of running a little bit short on time, since we do have some travel and buses that'll be taking us different places, we want to make sure that members are connected offline to the experts and the staff. And with that, we'll turn it over to the experts and the staff. Grateful for Secretary Chardon Clark, Secretary Probst, and of course our Chief Economist, Ismael Torres. We'll go over to you for whatever order you want to go.
Thank you, Mr. Chairman, members of the committee. It's a pleasure to be here with you, and I know you have an ambitious agenda today, so I plan to be a little more brief than typical, going through the macroeconomic slides, and be happy to stand for your questions afterwards. On the executive slide deck, I'll be taking you through the macroeconomy, the U.S. and New Mexico macroeconomic outlook, and then some details on our larger revenue sources like oil and natural gas, GRT, personal income tax, and corporate income tax before turning it over to Secretary Probst. Just a reminder on slide 3, the members of the Consensus Revenue Estimating Group worked very hard on this forecast, as always. On top of the forecast, they've also been working on digesting everything in the federal H.R. 1 and making sure that, to the extent possible, the impacts of that bill are also included in the estimate. I want to highlight that the members of the DFA, Tax and Rev, and LFC economist teams are here. Just wave to the group. We're very thankful for your contributions. Okay, on to slide number 4. We'll talk a little bit about how the baseline forecasts that we subscribe to from Moody's, S&P, and UNM's Bureau of Business and Economic Research have shaped up since the previous estimate that you received in December 2024. So starting with Moody's and the national economy, U.S. GDP growth was expected to have been 1.5% in 2025 and flattening out to 1.3% now in 2026 and growing a little bit faster in 2027 at 1.7%. Consumer spending remains the primary driver supporting U.S. GDP growth, with federal government spending coming downward and trade being a net drag on the U.S. GDP growth. In the U.S. labor market, hiring is slower but still positive, and unemployment is now expected to rise towards the 4%, mid 4% range in 2025. The inflation forecast from Moody's is slightly elevated over the previous estimate. The Fed is expected to hold Fed funds rate steady until September. That's just next month now, with rate cuts expected by Moody's in September and December 2025. They are expecting a weakening economic forecast to outweigh inflation concerns for the coming months. Tariffs, the U.S. effective tariff rate is expected to peak at 18%, easing to about 13% in the second half of 2025, compared to, for reference, a 2% average effective tariff rate in the beginning of 2025. On to S&P's forecast. They assume a little bit different on the actions of the Fed. They were assuming the Fed would hold rates stable until December 2025 without a rate cut in September, and then proceed with 3 consecutive rate cuts of a cumulative 75 basis points. Similarly, they assume national GDP growth in 2025 at about 1.4%, down pretty significantly from what was expected of 2.1% in October 2024. They're similarly looking at a national unemployment rate peak of 4.6% in 2027. And notably, the H.R. 1 federal bill is not incorporated into S&P's forecast. but their forecast did assume that many of the provisions that ended up in that bill would. And then finally, UNM's Bieber forecast has New Mexico unemployment growth remaining pretty close to what was estimated by Bieber in December 2024's forecast, coming down from 1.1% in the last year to 0.2% so we've got a real flattening of the employment growth in New Mexico. And then they're now expecting unemployment to peak a little sooner than before at 4.8% in 2026. Okay, so that sort of sets the stage, right? We've talked about the major economic indicators that have gone into today's forecast. Next, I think it's helpful just visually to look on slide 5 and on at how some of these projections have changed since the last estimate. So on slide 5, I'll go pretty quickly. You can see if you compare the gray line is what we're now expecting for U.S. GDP growth. Compare that to the blue dotted line. That's what was expected in the last forecast. You can see that the expectation for U.S. GDP growth has cooled. Next, we look at the same data on slide 6, but for the state of New Mexico, and very similarly, following the national trend, we're expecting slightly less robust GDP growth in the state, GSP growth. On slide 7, we can look at the U.S. Employment forecast, and again, it's expected to be just a little bit less robust than in the previous forecast. Non-farm employment increased by 73,000 in July 2025, and nationally, year-to-date average job growth is about 85,000. The gains are centered primarily in health services, social assistance, retail trade, and financial activities. But it is showing signs of moderation. The trade war internationally is weighing pretty heavily on the job market. Interest rates are also dampening hiring decisions, and the private sector is more cautious in its outlook. On slide 8, we'll move to New Mexico's employment forecast. And in our case, it actually exceeds the previous estimate somewhat. Employment gains averaged about 1,800 jobs per month in calendar year 2025 so far, and New Mexico has been adding or just recently added 2,900 jobs in June 2025. Employment grew in New Mexico by 1.5% in calendar year 24, and that is expected to level off to just 0.1% employment growth in calendar year 26, and level flat growth, no growth in calendar year 27. On to slide 9, we've broken down the recent year-over-year employment growth by sector in New Mexico. So over the last year, from June 2024 to June 2025, New Mexico added 17,400 jobs, and you can see strong growth across about 2/3 of the sectors. Construction notably grew 14.8% with 7,900 jobs, and I'll let you digest the table without going through them all out loud. On slide 10, we've added a new slide breaking down employment by sector so that visually you can kind of get a sense of which sectors in the New Mexico employment base are the largest and the most dynamic. So, of course, we have about 906,000 jobs currently. Education and health account for about 17% of those, construction another 7%, and on down the list. On slide 11, we've provided some new data about labor market tightness. This is a graph that basically is demonstrating the number of job openings available versus the number of workers looking for jobs. So when you have more openings than workers, you have a tight labor market. When you have more workers looking, then you have jobs. It would be a slack market. And so one on this table would show an equal number of workers for jobs. So most recently, historically, New Mexico had a fairly slack labor market with more unemployed than job openings, but currently both New Mexico and the U.S. have a tight labor market with more job openings than unemployed who are looking. On slide 12, we look at both the forecasts for the U.S. and the New Mexico unemployment rates, and you can see New Mexico in recent since 2022 has really met or been a little bit better than the U.S. average, and that's continued to hold, expected to hold. The unemployment rate currently in New Mexico is about 4.2%, and that's right on par with the national average. On slide 13, we turn to inflation forecast and interest rate forecast, which sort of go hand in hand as two sides of the same coin. On the right-hand side, we're looking at consumer price index, which is the best way to look at inflation as a projection. The consumer price index has been higher than anticipated since the previous forecast, but is expected to reduce a little further in 2027 and beyond than before. So near-term inflation is higher than expected, but in the longer term, it's expected to be a little lower. Gasoline decreased by 8.3% compared to June 2024. And shelter has been, for the last several years, a stubborn part of inflation, continued to rise by 3.8% compared to June 2024. On the right-hand side, we can see the estimated or the anticipated actions of the Fed. So basically, the target rate that the Fed is expected to target remains unchanged, but they're expected to get there a little more slowly than before. All right, next we'll turn to oil and gas markets, of course, a major determinant of New Mexico's revenues. On slide 15, we can compare the oil price forecast to the previous. And oil prices, of course, are influenced by many global issues, global demand for oil, policy decisions made by OPEC+, geopolitical events in oil-producing regions. The forecast for oil price has been revised downward considerably since December 2024. For FY25, the year that has just concluded, it was revised down by $1.50 per barrel. For 26, the current year that we're in, it's been revised down by $7.50 per barrel, and for the out year, the budget year, by $9.50 per barrel. And in the out years, prices are expected to average in the mid-60s. You can see the actual projections in the table on the lower right. Some of the key factors that are driving this price outlook are that OPEC plus supply increases are having an impact on price. Rising North American production, including here in New Mexico and the Permian Basin, is impacting prices. And then globally, there is expected to be weakened demand with economic activity cooling, not just in the United States, but globally. And then there's a lot of uncertainty about U.S. trade policy and tariffs that are potentially dampening consumption of oil. On the next slide, instead of talking about oil prices, now we look at oil production volumes that are expected to occur in New Mexico. Production volume, whereas the price forecast is down, the production volume forecast is revised upward. We're expected to have produced an additional 30 million barrels in FY25 and an additional 20 million in 26 and 15 million barrels in FY27. FY25 production is projected to have reached a record for New Mexico of 775 million barrels. That's up from 710 in FY24. The rig count has declined somewhat, but does remain stable. We currently have about 96 rigs, where previous it was hovering at maybe about 104. Some of the factors shaping the outlook for oil production in New Mexico has a lot to do with corporate activity and expectations. Weaker price expectations are increasing the corporate break-even points. Slowed projected economic growth is creating uncertainty for producers, and capital discipline continues to be a constraint on production. On slide 17, we'll turn our attention to natural gas, which is another large driver of New Mexico's revenue. And in this generation of natural gas production, natural gas really is tied to the oil market pretty tightly. This natural gas is coming up along with oil, and sometimes we are catching up on the transportation and production constraints that are coming along with that volume of natural gas. The natural gas production is expected to reach 3,915 BCF in FY25 at an average price of $3.31 per MCF. Near-term production growth is following, as I said, the oil trends, but long-term growth is going to be driven by rising demands for New Mexico's natural gas globally. including liquefied natural gas. U.S. supply growth is supporting higher international demand, and that is putting upward pressure on the price for New Mexico natural gas. It's up 16 cents per MCF for FY26, and in FY27, it's revised up by 22 cents per MCF. On slide 19, we'll turn our attention to the largest single revenue source for the general fund, the gross receipts tax. For FY25, the GRT estimate was increased by $76 million over the December 2024 forecast, which is pretty significant upward revision given that year is basically concluded. The current August forecast estimate has lower year-over-year growth, though, expected versus December, as again we're expecting, as I mentioned at the beginning, less robust economic growth in New Mexico and nationally. So for FY26, year-over-year growth is now expected to be 3.8% versus 4.9% in the GRT. And also FY27 growth has cooled to 2.7% versus 3.4% in the previous forecast. So while we had a fairly big upward revision of $76 million in the FY25 year, we have only increased the FY26 forecast by $17 million, and FY27 and 28 are basically unchanged from the previous forecast. So the base is higher to end FY25, but the expectation for growth is lower. So they're unchanged in the out years. On slide 20, I can skip over this, but leave it for you. We've charted the matched taxable gross receipts by sector in New Mexico. Matched taxable gross receipts is the GRT base, and you can just sort of compare how different sectors grew from 24 to 25. And then on slide 21, we've provided a detail again on matched taxable gross receipts just in Eddy and Lee counties where the Permian Basin is located. Really, again, just to emphasize the tie between oil price leading to rig activity, which leads to GRT being collected. On slide 23, we'll go to the personal income tax outlook. For FY25, the personal income tax contracted or declined by 0.7%. But that was actually better than expected. In the last forecast, we expected it to contract by 7.8%. And as I mentioned in the last forecast, that's not a sign of underlying weakness in our personal income tax. That's a result of legislative changes that were expected to reduce the PIT. We made cuts to it. But that is an increase of $156 million in PIT for FY25 versus the last forecast. And the reasons it outperformed basically, we had less than expected taxpayer uptake of some of the most recent personal income tax cuts. And in fact, it was about 75%. So another way of saying that is that when we passed that legislation, we scored the fiscal impacts of legislation against the revenue estimate, but the fiscal impacts were a little lower than expected because of taxpayer activity. We currently have about 31, just as one data point, we have about 31,000 letters sent out to taxpayers from the department who we think are eligible for the child tax credit but didn't claim it. So we are working on trying to get uptake higher, and that'll depend on taxpayer activity. For FY26 through 28, for FY26, the personal income tax forecast has been revised upward by $119 million, upward by $91 million for FY27, and upward from $68 million for FY28 from the last forecast. PIT growth is still positive, but it's growing at a more moderate, leveled off rate than it was in the December 2024 forecast. And the moderated growth is in large being driven by both slowing withholding, that has to do with economic activity, as well as the rate reductions that were made in 2024 legislation, and then the impacts of the federal H.R. 1. To get a little more detail on those recent legislative changes that have been impacting the personal income rate cut, I think 2025 is good to look at. You can see on the far left, FY25 was in the darker shaded columns. That's what we expected, these recent legislative changes to reduce in revenue. But in the shaded bars, you can see what they preliminarily were in FY25. So For example, the child tax credit, as I was mentioning, is the gray bar. You can see that the amount claimed was pretty significantly less than expected, and so on. On slide 26, we talk a little bit about the adjustments that have been made to the forecast to reflect the changes that have just been made federally under H.R. 1. The main things, and I've presented this to RESTEP and as well as the Federal Funding Stabilization Committee in more detail, but the federal government has changed the standard deduction, and that will reduce personal income tax revenue by about $41 million per year. The federal government has provided for no tax on qualified car loan interest. That will reduce New Mexico revenue in turn by about $5 million per year. So there's a total loss of about $46 million from those provisions to New Mexico for conforming to the federal return. Next, on slide 28, I'll talk a minute about corporate income tax. The corporate income tax outlook for FY25, we decreased the corporate income tax forecast by $15 million over the previous estimate. That includes a decrease of $35 million of pass-through entity tax, which is incorporated into SIT, but also to offset that, the film credit forecast was reduced by $155 million. So we reduced the estimate for new incoming gross corporate income tax, but we more than that reduced the expectation for refundable credits being paid out for film. So we had a net decrease, when you net those things together, we had a combined increase in corporate income tax of $104 million. The gross corporate income tax and pass-through entity forecasts have been revised downward for the outlook. It's decreased by $155 million per year in FY26 and 27. Legislative adjustments continue to include the new corporate income tax credits that have been enacted, and then moving from a marginal SIT structure to a flat 5.9% corporate income tax. And then again, similarly on the next slide, 29, we have incorporated expectations for how the federal H.R. 1 will impact the corporate income tax. We estimate that by limiting the cap on state and local tax deduction, we'll have an average reduction in corporate income tax of about $70 million per year across the PTE revenue. And then everything else combined from H.R. 1 is expected to reduce SIT by $44 million per year on average. So a total of $114 million negative to corporate income tax as a result of the federal bill. Okay, in my last section, we'll talk a little bit on slide 31 about severance taxes, rents, and royalties. These are the direct revenues benefiting the general fund from oil and gas production. On slide 31, I think it's a nice visual to show, basically in blue, you have the amounts of these revenues that are going to the general fund. And then as a result of fairly recent legislation, you can see the amounts of sort of windfall oil and natural gas revenue that instead of hitting the general fund and creating volatility there, are instead being set aside for future use, whether it be in the early childhood trust fund or the tax stabilization reserve or elsewhere. And so I mentioned a few minutes ago that we've revised downward pretty significantly the forecast for the price of oil. But today we will not necessarily need to see that reduction in the price of oil is going to hit the general fund. Instead, the general fund is now insulated from that volatility, and what will be instead reduced are these transfers to other funds. General fund, again, severance tax revenues coming to the general fund are now capped at FY24 levels. So since we're still in excess of that, we've had no change to the amount of general fund that's expected from severance tax. It's $1.145 billion. I won't go through all these in detail, but you can see basically the transfers that are expected to occur to these other funds. A note on a recent federal change that is actually hitting the general fund, but at an undetermined time, and this is the non-recurring issue. You may be familiar with the Federal Royalty Resiliency Act of 2024, or RRA. This is a federal bill affecting federal royalties that are shared with the states. This was effective September 1st, 2024. And from an industry perspective, this federal legislation was intended to streamline royalty payments so that producers could apply for production and get to work producing more quickly. And so it allows producers to submit to the federal government these commutization agreements, or CAs, and unit agreements, and they could begin producing, and then on the back end, the federal government would reconcile. When production occurred, they are going to tell the federal government what type of land they're producing on: federal land, state land, tribal land, private land. And the federal government says, go ahead and start producing. We'll reconcile what land type this is on the back end. Okay, that sounds good for producers. They can get to work more quickly. But in actuality, New Mexico has over 800 unreconciled commutization agreements. And it turns out the federal government has alerted us that they've over-distributed to us on the assumption that more production was on federal land than actually was. So what will happen is we're currently expecting about $150 million to be clawed back out of future royalty distributions from the federal government as a result of this. That $150 million, give or take, represents over distributions of royalties from September 2024 through May 2025. And so we have included that in the August here forecast. We're not sure exactly what month it will hit. And for reference, I think our monthly royalty distributions from the feds are about $250 million a month. So to put in perspective, that's less than 1 month's activity. And finally, H.R. 1, a little bit more about how that federal bill will impact New Mexico's royalties that we receive in the future. So before the new H.R. 1, we had recently, through the federal government, increased the royalty rate from 12.5% to 16.67%. And we received 48% of that. So the royalty rate, half of it, less a 2% administrative fee. But because of H.R. 1, now the royalty rate is once again being reduced to 12.5%. So we will now receive 48% of that reduced amount. The Craig baseline uses a 12.5% royalty rate. So estimated $1.7 billion of lost royalties over the next 10 years is expected, or an estimated $170 million annually. I'll turn over to Secretary Probst.
I thought it would be green. Good morning, Mr. Chairman, members of the committee. My name is Wayne Probst with the Department of Finance and Administration. Ms. Chairman, start off by congratulating you on your ascension to the chair of the Legislative Finance Committee. That's a very exclusive club in the history of New Mexico, and look forward to working with you and your staff and the committee as we begin to prepare for the upcoming session. Mr. Chairman, I keep thinking that one of these days I'm going to have to show up with some bad news. But fortunately, today's not that day. The fiscal position of the state of New Mexico remains strong. It remains stable. It remains resilient, with multiple protective layers of cushions. Senate Bill 26, Senate Bill 78, House Bill 253, reserves above 30%. For us to be able to deal with hopefully most, if not all, expected and unexpected events. Today's consensus revenue forecast general fund overview reinforces all of those positions with regard to where we are as state of New Mexico. On slide 36, Mr. Chairman, this is one of those slides that Secretary Chardon Clark covers most of the information. So I'm not going to spend a lot of time here. I do want to highlight in FY25, the third, or I guess it's the second FY25 highlight, that investment income for the state grew at 11.3%. That is reflected on the bar chart to your left in the blue piece of that chart. And it indicates that what we have talked about many times with this committee is that we have now taken significant volatility out of our revenue projections and forecasts related to oil and gas, and replaced that with investment income earnings, which at some point in the not too distant future will become the largest source of revenue growth, general fund revenue growth. FY25, the last bullet, I want to highlight that as well as a result of some revisions to the December forecast. FY25 is now projected to close at $390 million above the estimate that we provided to you in December of 2024. That $390 million is in reserves and has increased, as you'll see in a slide or two, our projection of reserves for both FY25 and FY26. For the FY26 outlook, Mr. Chairman, members of the committee, again, investment income earnings will play a large part in our revenue growth and revenue available for recurring and non-recurring expenses. And then for FY27 to FY30, as Secretary Chardon Clark noted, sales and income taxes are expected to return to moderate growth, but remain slightly below our 10-year trend. Investment income will become an increasingly key driver for general fund growth. As I've mentioned, general fund share as a result of investment income growth is expected to go from 14.5% in FY24 to 20% in FY30. Slide 37. What we're all here for, Mr. Chairman. How much money, total new money, can we expect for FY27? You'll see and I'm sorry for the small print, but you'll see that we are expecting an increase in total new money for FY27 of approximately $485 million. We generally, as a consensus revenue growth group, look at that as potential revenue for recurring expenses, but it does not need to be appropriated for recurring expenses. It could be appropriated for non-recurring expenses. But overall, for the FY27, we are anticipating an additional $485 million, which is pretty remarkable. In addition to that, Mr. Chairman and members of the committee, you'll see that below that, we are anticipating $2.8 billion of last year's appropriation levels to be available again in FY27. And this is, Mr. Chairman, the pot of money that we generally look at for non-recurring appropriations and expenses. Again, it does not need to be expended for that, but that is how we generally look at this slide. New money is $485 million, but there will be $2.8 billion, similar to last year, non-recurring appropriations that are available. Slide 38, Mr. Chairman and members of the committee. Again, FY25 came in stronger than anticipated. FY25 reserves, general fund reserves, are estimated at $3.47 billion, or almost 34%, versus what we were projecting in December of general fund reserves being at approximately almost $3 billion and at 29.2%. And again, FY25 revenue came in $390 million higher than we, as a consensus revenue group, projected in December of 2024. For FY26, growth is slowing. That probably does, I'm sure it doesn't come as a surprise to anybody on this committee or your staff. This was anticipated. It has slowed a little bit more than we thought it would as a result of some of the reductions that Secretary Chardon Clark covered in her last slide related to federal appropriations and tax policy. But we are still projecting some growth in FY26 with FY26 general fund reserves at almost $4 billion, or 36.4% of recurring appropriations. Again, this is significantly higher by almost $500 million than what we anticipated or projected in the December 2024 consensus revenue report to you. Of course, the FY26 reserves are pending any appropriations that you make in the upcoming session, so that number will go down. But again, very, very strong reserves projections for both FY25 and FY26. And then finally, again, Mr. Chairman, for FY27, we are projecting a total amount of new money to be almost $485 million. On slide 39, this is very repetitive of what the information I've just provided to you, but with a little bit more detail if you'd like to go through it. Again, highlighting FY25 reserves being projected at almost 34% and FY26 reserves at 36%. As a reference point, Mr. Chairman, every $107 million equals about 1% increase or decrease, depending on the way it goes, but $170 million equals 1% to our general fund reserves. Turning to slide 40, Mr. Chairman and members of the committee, you all are familiar with the next few slides. This is, as you know, our economists, working with our consultants, Moody's and others, spend a lot of time on looking at risks to the forecasts that we present to you. I'm not going to go through these line by line. You can read them. Some of them are both downside and potential upside risks. There's been a lot of focus, of course, Mr. Chairman, on possible impacts from the federal budget process. I think we should also, Mr. Chairman, as we look at our risks to our forecasts, focus not just on one particular piece of legislation, but the near and midterm economic outlook. Right now, things are looking reasonably good. My 401k is doing pretty well these days, and I hope yours is too. But I do have some concerns that there are some cracks showing with relation to potential slowing of growth, continued inflationary pressures, and impacts to employment. So these are risks. Some of them I think are higher risks than others, but I do think it's important that we go through this exercise with you and you as well determine what you consider to be risks to these forecasts that we present to you. On slide 46, this is the actual stress testing that we do, sort of like the old proverb, be prepared for danger in times of peace. In times of peace, be mindful of dangers. That's what we're trying to do here. But again, this slide tells a remarkable story and ties back to some of my opening comments about the fiscal position of the state being stable, strong, and resilient, in that even under the worst case scenario that we model, and that's the small red dotted line, that's the low price of oil scenario, and that price is approximately it's in the mid 30s for a price of a barrel of oil. You'll see that there's some less money available for non-recurring appropriations, but we still are well above existing levels for the past several years of appropriations that have been made through the legislative process. And that low oil scenario we place at a 5% probability. So again, shows that even in unexpected circumstances, we have taken into account significant stresses to this forecast, and we remain in a very well positioned even in the worst case scenario. Slide 42. Similar information under the low oil price scenario, recurring appropriations in FY26 remain well above the negative impact of an oil shock of that magnitude. But again, there would be some less money available, estimated at approximately $1 billion of the $2.8 billion that was appropriated in FY26 for non-recurring appropriations. Doesn't mean we wouldn't be able to fund non-recurring appropriations, but that would likely be at a lesser level than we've been able to do in the past. I do think this is important, Mr. Chairman, as the executive and the legislature begin to put together their budgets to focus on that non-recurring pot of money. We, from the executive perspective, expect that we will need to make some significant investments in Medicaid and SNAP in particular. We would like to see the trust funds for both behavioral health and Medicaid that you established last year. We'd like to see those filled up as soon as possible and potentially ahead of schedule. Having $2.8 billion in non-recurring appropriations available for FY27 gives us an opportunity to do some of those things from our perspective. And Mr. Chairman, on slide 43, the revenue trend, general fund revenue versus the 10-year trend. We have dipped below the 10-year trend of 9.7%, but that's okay. A little bit below 9.7% growth, I'd take any day of the week. And as we always note with this slide, what is important here is that those two lines remain as close together as possible, because that means that we have eliminated, to the extent we can, volatility in our projections and revenue outlook. So, Mr. Chairman, we're pretty close there, as we have been the last couple of revenue forecasts that have been presented to this committee. So once again, on slide 43, good news. I'll close, Mr. Chairman, with reiterating that from my perspective, the state's fiscal position is strong. I'm not sure of too many other states that are in the position that New Mexico is in, with continued revenue growth, albeit declining or slightly, with very strong reserves. And because of the actions that the legislature and the executive have taken together, particularly over the third year, as I mentioned, a lot of opportunities to continue to make investments in your priorities and the priorities of the executive as well. I will close, Mr. Chairman, by saying that the executive continues to support very strong reserves of 30% or higher. I think sometimes when you're facing periods of uncertainty like we are now, it's good to let the dust settle a little bit, see what the real needs are, and be a little bit cautious. And I think that's how we will be approaching the executive budget recommendation that will come out in December. But we do continue to support strong reserves. I think we can continue to maintain those and make some of the investments that I have mentioned, such as the Medicaid and behavioral health trust funds, any gaps in as a result of federal actions as well. So, Mr. Chairman, thank you for your courtesy, and nice to see you all.
Thank you very much, Mr. Secretary. Mr. Torres, and welcome back home.
Thank you. Good morning, Mr. Chair and members of the committee. My name is Ismael Torres. I'm the Chief Economist for you all at the Legislative Finance Committee. And you can find our materials behind tab A in your binders. It should look like this. And I know we're running short on time and you all have a bus to catch, and I think this makes really good bus reading material. So I think if you want to take it with you and dive deeper, we're always here for questions. If you find anything of interest or anything you want to dig deeper on in the briefing materials, please reach out to us, and we're happy to set up one-on-one times or group times with you or your staff. And I think my three goals or maybe takeaways for this presentation from this new revenue update are threefold. One, what the revenue figures are, and hopefully help contextualize that in the bigger picture in terms of what they looked like before and what they look like today. And the short of it is less new money, less growth, and hopefully I'll do a better job contextualizing that shortly. But two, it's that from my perspective, the economic forecast has shifted in some ways. We had been predicting a slowdown, and that's certainly playing out. But maybe there's a little more shakiness to it this time around than we were expecting in previous rounds, and I'll get into that as well. And then lastly, it's the broad amount of uncertainty that we're seeing. It's actually expanded in many ways. I know probably as economists, you might hear us say that there's a lot of uncertainty always, but this time I really mean it, I guess is what I'm saying. It feels like the uncertainty has gotten bigger, in part because of the federal policy changes, but also in some ways because of these mixed signals that we're getting from the economic data and from the revenue data. So I want to start actually with the chart at the bottom of page 1. And this is a little bit of the challenge and the nuance of this revenue estimate. Sometimes it's easy, we get to come in and say it's all up, or in bad times we say it's all down. And the reality is it's mixed. You can see in FY25 a strong growth, a strong revision to the upside. We went from expecting 1.6% to 4.6%. That's good. But then in the next year, we actually expect that growth to go from 2.6 to 0.4. So that's bad. That's down. We're down from our expectations. And then you can see in the out years, we're down a little bit from what we expected previously. And what that translates to is the table at the top of page 1. If you look at the beige line there, all the way to the right in column FY27, that's the budget year that you all will be talking about in the upcoming session. You can see $14.1 billion estimated for the upcoming budget year. But if you look at the line above that, you can see how much this revenue estimate revised from December, and it's only $17 million. So we are only expecting $17 million more in the budget year this time around than last time around, and that's the combination of the upside in the current year or in the previous year, but then the downside sort of in the out years and what that translates to. And as Secretary Props mentioned, the FY25 column, $390 million is the extra strength in this year, and so that contributes to your reserve number or potential non-recurring spending in the upcoming session. And so maybe more to the point, the table or that little box, FY27 revenues less appropriations, these are what are frequently called the new money figures. And the old traditional new money figure is the one at the bottom there, $3.27 billion. And that's total, or that's recurring revenues less recurring appropriations. And that used to be a really helpful number back when non-recurring appropriations were maybe $200 million or less, $200 million in a good year. Now, you all know very well that non-recurring appropriations are now north of $3.5 billion in any given year. They're easily more than a third of total appropriations. And something I'll get into on the next page, they're actually happening in the future years. It used to be the case that non-recurring spending occurred in the current budget year, but now they're also occurring in the future budget year against expected revenue in the similar way that recurring revenues are. And what that can do is create a little bit of a treadmill where you're always having to forward appropriate non-recurring appropriations. And so what we find to be more helpful now is what we call total new money. So that's the total revenues minus the total appropriations, and what we see is $484.8 million, as Secretary Props mentioned. And to give you some more context, last year, we were closer to $900 million in total new money. So we have about half of the total new money this year, just further speaking to that slowdown that we have been talking about and expecting for several years now. So if you turn to the next page, on page 2, this is an abbreviated financial summary. This is our state's balance sheet at a very high level. And I want to draw your attention to the middle boxes here. So you have revenues at the top, your expenses in the middle, your bottom line at the bottom. Looking at the expenses, you can see those non-recurring appropriations, $3.5 billion in FY25, and in the future year, which is our current budget year now, back when you made the appropriations, it was the future year, $2.7 billion already made. So you can see the challenge coming into the next session to make more non-recurring appropriations in the current year. The capacity is limited, and you can see the transfer to or from reserves line, $80 million. That's all you have left between expected revenues in that year and your already committed expenditures in that year, only $80 million. So that's sort of that treadmill challenge that you all have in making appropriations into the non-recurring appropriations into the future fiscal year, which in some ways limits your ability to be nimble if revenues come in less than expected, or maybe just challenges you all to take the reserves a little more seriously to make sure you can cover the appropriations in that future fiscal year in case those revenues don't materialize. Okay, I want to move on to page 3 and speak a little bit to the mixed signals in the economic forecast. And if I could draw your attention to the employment forecast at the top, it might be a little hard to see, but the December expectations for employment growth was better than today. Our employment growth expectations have been revised downwards. And in part, that's being experienced on the national level. What we'd seen over the last year, the last 12 months, we had seen the national economy add about 150,000 jobs per month on average over the last year. However, in the last 3 months, we've seen that kind of go off a cliff, and we're now closer to 35,000 jobs per month. And those are coming from significant downward revisions to the jobs expectations, and those downward revisions can be an indication of maybe a turning point. For example, when the economy is doing really well, the jobs figures get revised up on a monthly basis. We get more information and we see that people were hiring faster than we had originally expected. And the inverse can be true. When the economy is doing poorly, we get more information and we find out that maybe people were laying off more folks than was expected, or maybe people were hiring slower than expected. And so we're in that downward revision territory, which is not in and of itself, a declaration that the economy is doing poorly, but it's certainly a yellow flag, you might say, to pay attention to what's going on there. And so we're seeing that, and that's something that's at the top of mind for us. Another thing that we're seeing is a slight uptick in inflation. Of course, we're all worried about inflation, and really what we're seeing is the start of some of these tariff impacts. As we saw in the latest figure, inflation ticked up a little bit, and we don't think that tariffs are fully baked into prices yet. And so as those tariffs continue to roll through the economy, we might see stronger and stronger inflation, and that actually is in the economic expectation, but if those come in stronger than expected, that could be a challenge. And I'll give you an example of this. Our national forecasters expected effective tariff rates to level out at around 10%. Well, that's what's baked into this forecast. We're already past that, and we're heading towards 15. So we might see inflation come in stronger than presented here. And so that's something that we're keeping an eye on and keeping at the top of our minds. Another thing that's not fully baked in, as was mentioned in the previous presentations, is the full impacts of the federal H.R. 1. The forecasters that this is built on expected an extension of the Tax Cut and Jobs Act, which was part of it, but some of the other pieces weren't estimated in this revenue estimate, and so we have to keep analyzing that, and the national forecasters have to keep analyzing that so we can see what the full impact will be in the months to come. And finally, I just want to point out labor expectations are both challenging because of the declining hiring rate. To the extent that new jobs are being created, that's slowing, but we're also having a supply side shock. We're having less folks in the labor force. And so what that can kind of do is hide in the unemployment data what exactly is going on. If less people are looking for work because less people are in the labor force, then it might look like the economy is doing better than it otherwise might be doing if those people had stayed, whether that's through earlier retirements at the federal level or through increased immigration enforcement actions, which are reducing the supply side of the labor market. And one last, mixed signal, yellow flag here is that I don't expect that the full extent of federal layoffs is showing up yet in the data. Many of those deferred resignations or deferred retirements take effect in September, so we will see that also in the months to come. So a lot of mixed signals and yellow flags in the labor market. Briefly, I'll turn to if you'll turn to page 5 with me to talk about oil dynamics. As Secretary Sheldon Clark mentioned, oil prices are significantly down. Interestingly enough, in the past fiscal year, we were very close. We were very close to on target for what we expected, but in the next couple of years, we're significantly down. $7.50 lower in the next year, and then almost $10 in the budget year. And what that translates to is more expectations for slowing and plateauing oil production growth, as you can see in the chart at the top of page 5. But a really interesting, maybe new development to me, or new perspective that was that I've taken up, is the natural gas production expectations at the bottom of page 5. You can see that chart there. Unlike oil, it's expected to continue to grow at a moderate clip. And as you all know, natural gas, especially in the Permian Basin, or specifically in the Permian Basin, is an associated product. When you go produce oil, you get a bunch of natural gas with it. But if you remember your oil decline curves, so much oil, peak oil production per well, occurs in the first 3 to 6 months and drops off very quickly after that. The natural gas associated with it from that well does not have as steep of a drop-off. It actually continues to produce at a much higher rate than the oil decline curve would suggest. And so what that means is, as these oil wells mature in the Permian, they remain with high elevated levels of natural gas production. And so we might see continued natural gas production growth despite oil production declines in the future. Let's see, I need to skip ahead here. If you turn to page 11, maybe some more, 10 and 11 here, maybe some more insights from oil and gas. Our updated rule of thumb figures is about $57 million per $1 price change. So if prices decline $1, we might lose $57 million in state revenues, expected state revenues. So you can imagine $10 price differential could translate to $570 million in less state revenue. But as Secretary Sheldon Clark mentioned, some of these insulating measures that you all have put into place, if you remember that bar chart, those take the hit first. And so the general fund isn't experiencing that decline. And then if you look on page 11, these kind of busy charts here show what are frequently called break-even prices, what price is needed in a certain basin to maintain production on an existing well at the top. You can see $33 on average in the Permian Delaware, $45 in the Permian Other, but the chart below it is perhaps more interesting, and this is what price do you need to profitably drill a new well? And you'll see the Permian Delaware at $62 on average. And that's, I just checked this morning, what we're sitting at today. So you can see how close we are on maybe a knife's edge on that price point to have much slower production growth. If prices fall below $62 a barrel, a lot of folks are going to be stopping new production, stopping new drilling, because it might not be profitable at that price. But there's a small amount of folks at the bottom of that bar who can still drill profitably down into the $40 a barrel, so we'll have some growth, but we'll have much stronger growth certainly if prices are higher, and that's translating into that plateauing effect that we're talking about on those previous pages. Moving on to page 13, I'll spend a little more time here. The table at the bottom is a breakout of our expected revenue losses from federal policy changes, and the chart shows something a little different than the chart Secretary Chardon Clark presented. This is maybe a high and low alternatives to our baseline expectations. At the LFC, we stressed it, we pushed it a little harder. How bad could these losses be, or how if things turn out really well, maybe they might be less of a revenue loss. And so you can see our expectations in the chart broken out by item on the right there. And what we see is maybe about $100 million. So we're expecting in this baseline about $206 million revenue loss from federal policy changes, but it could be north of $300 million and as little as maybe $131 million, I should say. And I want to point out another, back to one of the 3 points, broad uncertainty. This is, we think we've found the potential biggest impacts of these policy changes, but this is certainly not an exhaustive list. We're seeing a lot of national analysis still being done on the potential impacts of just the tax changes, much less the economic ramifications. But we're also still doing that analysis, and the Tax and Rev Department is still doing that analysis. And this is definitely not an exhaustive list, and more items might be added as time goes on, or maybe we'll see items come off as we determine that their impact is negligible or not materializing. If you'll turn to 14 and 15, on page 15, we have the stress test here, and the blue or the bottom shaded bars represent recurring spending, the white represents non-recurring. As I mentioned, non-recurring spending is happening into the future year, and so when we're thinking about how much reserves you might need in a potential revenue crunch where, say, oil prices crash or a recession takes hold of the economy, we take into account the non-recurring spending as well because you're committing that into the future year. And if you look on page 14, you can see the bars here represent how much money might be needed to cover those existing appropriations with no cuts to those appropriations. And it's about $1.2 billion in FY26 and $1.6 billion in FY27. That's about $2.7 billion total. That's about more or less 27% reserves just to cover existing appropriations. And then I'll close on page 16. Two things here. The trend analysis is hopefully helpful to you all in understanding where you might be in the grand scheme of things. The total trend, total revenues, you can see you're close to the trend. That's generally a good sign. If you have a large deviation from trend, you can be experiencing a bout of volatility. If you're close to trend, you might have a little more certainty on the forecast. But I want to point out the PIT revenue deviation. This is in large part because of those tax changes. So much revenue from that revenue source, personal income taxes, has been returned to taxpayers, and you can see the divergence from trend from the result of those tax changes. But really the highlight here for me on page 16 is the general fund balances. When we had a surge in revenues over the last couple years, you could see those reserves surge as well. But as appropriations have certainly picked up and in the last couple of years outpaced the revenue growth, you can see how reserves have come down. And that's even with the inclusion of a couple of new reserve funds, the Behavioral Health Trust Fund and the Government Results and Opportunity, the GROW Fund. Those both have been added and counted towards reserves, and that's about 8% of reserves now. So, if you're looking at this general fund reserves chart, we're north of 30%, but maybe about 8% of it is in trust funds or other maybe or funds with other missions than reserves there. So just important to keep that in mind. And then lastly, I just want to make a pitch for our website. All of this data is being uploaded there into interactive dashboards that have downloadable functions. And so that's live as of this morning. And you can find that at www.nmlegis.gov/econ. And with that, Mr. Chair, I think we're ready for questions.
Excellent. Thank you very much. We'll go straight to questions, starting with Representative Chatfield.
Thank you, Mr. Chairman. Mr. Chairman, I remember last year when we were talking about this very same subject, being told that the one thing that might really throw us a bump in the road was Medicaid. The feds were going to cut out a certain percent of our Medicaid funding, and that has happened. And I know you went slightly into it, but tell me how we stand on the Medicaid debt in the state of New Mexico.
Mr. Chair and Representative, thanks for the question. I would draw your attention to that table with the OBBA impacts in the LFC briefing materials on page 13. I think it's really important to keep in mind the distinction between federal revenues that go towards supporting appropriations. So there's sort of the budget impact, and then there's the revenue impact. And today, just talking about the revenue impact, we do expect that the declining Medicaid enrollment and the restrictions on state-directed payments to have an impact on insurance premium tax revenues. That's both to the general fund and to the healthcare affordability fund, and also the gross receipts tax on those insurance revenues. And so that's at the bottom of this table. Our current estimate is $46 million loss because of those changes. But then, of course, there's also the budget impact, which I'm sure you all actually will get a presentation on later this week on the potential budget ramifications of that outside of the revenue implications.
So, Mr. Chair, we have reserves to cover that. We're good. Yes or no?
Mr. Chair, that may not be as big of a budget impact as was originally expected, and I'm sure you'll get into that, but reserves can be used for that purpose or for other.
Thank you. That's what I wanted to hear from you. Second question, in the risk factors, one of the things that I see out there possible is an embargo on Russian oil. If Putin doesn't settle, we're talking about maybe an increased tax on Russian oil. Was that brought into the risk factors at all? I mean, we're negotiating that right now. Doesn't look real good to me like Putin's going to settle. The threat is if he doesn't, well, then we're going to do something about trade, either shutting down his ability to export oil or putting some kind of tax on it. Is that included in the risk forecast?
Mr. Chair and Representative, I would say the bigger risk to our forecast is actually maybe the lifting of restrictions on Russian oil that could bring a lot more oil onto the market and drop prices. That's a bigger risk likely than more restrictions.
It can affect it either way, if we put more sanctions on them or less.
More restrictions could boost oil prices if less Russian oil entered the market.
So I guess my question was, is that in this risks forecast?
Mr. Chair, to the extent that it could be a possible low oil price scenario, that's one of our stress test scenarios, but changes to the current status quo on Russian oil supply, there are no changes expected in this forecast.
Last question. Natural gas. Oil is going down. Natural gas is in higher demand and going up. Can you tell me some of the factors that cause it to be in higher demand internationally and nationally? Just right quick, and I'll shut up.
Mr. Chair and Representative, just quickly, broader, more supply capacity out of New Mexico certainly helps, but global demand for natural gas is increasing, especially as a replacement, to your last point, for Russian energy supply, especially in Europe, but also in the Asian markets as well. So global demand is up and our takeaway capacity is increasing.
Thank you. Thank you, Mr. Chair.
Thank you very much. Next, we're going to go to Vice Chair Munoz.
Thank you, Mr. Chairman, and thank you guys for all your hard work and everything you've done. It's been since 2020, it's been quite a difference in the state of New Mexico. And I don't know whether you call it, it may be a curse to New Mexico that we're reliant on one revenue source. And I'm hearing your lecture in there, Izzy, reading between the lines about everything slowing. But if everybody looks to page 52, so you can get a brief history lesson, if you look back in New Mexico from 06, you can go to 2016, the amount of money that we had in reserves in our budget maybe in 2016 was about 5.3 billion. I'm going to guess right in there, 5.6. And in 2016, we were bouncing checks. And then we hit this slow growth to boom and raised what we want our reserve target rates to be, right? We funded everything we could fund in New Mexico, from early childhood to free college to you name it. We got money and we spent it, and we targeted things in the right places, I think, but they haven't come to fruition, right? We're still in a declining job market. We're still in slow economic growth. We're more reliant on federal money than ever before between the labs and the federal government. And we're not seeing that growth in New Mexico with the amount of investments we did. But New Mexico has never been in a more stable place than it is today. This is the most stable economy in New Mexico, and I've been here since 2009. And that was, I think they call that the Great Recession. What do they call it in 2016? Were you still in school then? The oil bust. And so you look at those years and you say, okay, what can you do to make a state more resilient, right, and less dependent? And we spent money. We spent money where we think it would work and where it would help. But it hasn't come to fruition, and we've got that resource curse of oil and gas that we're relying upon. 50% of our budget is reliant on oil and gas. And I don't know how we're going to get there. Let me ask you some questions. On the Fed rates cuts on federal lands that I seen in the presentation, that's a cut to about 170 million, right? 1.2 billion over 10 years. And so that's non-reoccurring money, correct?
Mr. Chair, that is recurring money in many ways, but a lot of it is already being diverted to other funds, and so the loss isn't necessarily experienced by the general fund.
Okay. And then how have you guys done an overall look in this estimate of what's happening in the economy? I mean, how much is this related to an increase in GRT, which is our biggest increase? How much is related to inflation? So if we taxed a box of cereal, and a box of cereal in 2023 was $2, and today it's $3.85, how much of that inflationary increase is related to GRT? Could you separate that number? And Madam Secretary, she looks like she's...
Mr. Chair and Mr. Vice Chair, we should talk about something other than a box of cereal, since that's deductible.
Name a car tire.
But yeah, if you, I'm not on the right slides, but if you were to look at, we can look up the growth in GRT, and we can look up the growth in inflation in the economic indicators table, and you're correct that inflation is a part of the growth in GRT, as is population, which is a lesser factor right now, but it would be also.
But we're on a population decline, less than 0.2% growth in population in the state of New Mexico. But do you know what that deviation number is? Because in order to try to figure out, are we really growing GRT, or are we really growing it off inflationary pressures, and that's driving that number higher?
Mr. Chair and Mr. Vice Chair, on page 6 of the LFC brief, the GRT growth rate was 4.9%. And so, we might have been closer to 4, maybe a little below 4 in terms of general inflation over that year, maybe even less. So I would say probably around 1% or more if you're trying to take the difference between the GRT growth rate and the inflation rate.
And you think that's pretty accurate, though, huh? With
we could do better analysis than that, but it might be a good magnitude.
Well, if anything happens in the economy, right? If the economy slows, it's slowing, right? I talked to a home builder in Albuquerque, and he's only sold 2 new homes in 2 months. So it's slowing. The economy's slowing in everywhere. Certain sectors are still strong, but certain sectors. And the instability with what's happening in the federal government and across the world is creating nervousness for investments across, and people are holding on to cash. And when that happens, we got to figure out where we're really going to be at if we hit not really going to call it a recession, but more stagflation, because interest rates are high and inflation is high. And the odds are, the economists are saying that we'll hit more stagflation than we'll hit a recession, but we may not hit anything. But we got to really figure out how to get to a true number of where we're at with growth. I can't name an agency in the state of New Mexico that hasn't received a windfall. The early childhood secretary sitting there, she got a $500 million windfall last year. There's nothing that an agency needs in this next year. They may have wants, but what are they going to need? And then the question becomes, how are these agencies going to spend that amount of money in less than 6 months? Because at 6 months, they're capped. They can't spend that money. So when these agencies come forward and say, oh, we need these increases, I think we're looking at a really flat general fund budget. It can't grow because expectations in a 6-month time period, they're probably not going to achieve their goals. And a lot of the cabinet secretaries leave at that point. Administration's on their way out. Work slows and new administration's going to come on board, and they don't know where their next job is going to be. But as we move forward, can you tell me any place that you can think of in the state of New Mexico, Mr. Secretary or Izzy, that we didn't put money to make New Mexico move forward?
We can go through that yeah.
Yeah, that's fine. I mean, we put a lot of money out in the economy, but we haven't seen the returns. But we're at the point in New Mexico where this is the most cautious year that we can be. We know that if we spent, and this was our revenue projections over the last 3 years, if we increase by 6%, we can grow to 2030. Well, that may have changed now. And so now we got to start tampering down, because if anything happens to us, the SNAP program is going to cost us $250 million. There's $468 million of new money. There's half of it gone. You look across the $170 million in losses in the federal revenue, you look across the board on everything else that we're going to have to adjust, that money disappears in an instant. And you can't spend everything out of reserves, and you can't spend everything out of your funds to try to shore it up quickly, because we don't know what's going to happen in the next 3 to 4 years in this administration. We're only 7-8 months into this administration, and we're making a lot of change. So for the next 3 years, it could be even a different roller coaster ride. And New Mexico has proven itself that we've increased our bond rating, and we've proven to ourselves that we can hold cash and create stability in the state. And that's the most important thing as we move forward with these revenue forecasts and spending, is how we're going to do that. So we're in a safe place, and we're not in the 2016 situation where we're bouncing checks, where the treasurer should have went to jail, but didn't, to pay people. And New Mexico can never be in that situation. As long as I'm around, we'll try to keep that straight and narrow and keep us on path for investments and spending. So thank you, Mr. Chair.
Great. Thank you very much, Vice Chair. We're going to go next to Representative Sanchez and then Representative Lente.
Thank you, Mr. Chair. Izzy, I think you mentioned the price per barrel of oil, and I thought you mentioned that we're pretty close to the price where production either slows down or stops. I know there was an attempt last year to increase the taxes on oil and gas significantly. Is there any chance that increase would have knocked us below that number and stopped production or slowed it down?
Mr. Chair and Representative, that's a good question. I think the increase was certainly less than 1%. I don't know, off the top of my head, was it 0.85? I was going to say 3/4. So, I guess one way to think about it is because it's dependent on price, on value, you could say that the price breaking point would increase by that 0.85% of $62 a barrel. So, maybe at risk of doing quick math, 50 cents or less might be added to that sort of price point.
Thank you, Mr. Chair.
Thank you. Representative Lente.
Thank you, Mr. Chairman. Thank you, Secretaries and Chief Torres, for your presentation this morning. A lot of discussion was made on non-recurring expenses and the effect that it has not only just now but into out years. As I thought of non-recurring, it goes to my mind, non-recurring being, in my head, was the lion's share is probably capital outlay, but it actually isn't. Capital outlay reflects about 30% of that non-recurring spending. And for all of us, that capital outlay practice and process is really, in many cases, the way that many of our districts and many of the communities in our districts get that drink of water each year for projects that are really essential in our communities. And when you think about that 30% of the total, last year or for this fiscal year, it was about $800 million in capital outlay. And so as we look at the modernization of capital outlay, to which we'll have a presentation on Thursday of this week in regards to the work that we're doing in that subgroup, it's going to be really important in terms of how we move forward in looking at the modernization of capital outlay. And I think for the staff that are presenting this morning, especially for those in the LFC group, does that mean that perhaps we need to begin to look at managing expectations for legislators so that senators can't expect to get $4 million plus per member, and House members shouldn't expect to get $2.5 million per member, and the governor get her share? I think we have to begin perhaps to look at that. If that's premature, then tell us why it is premature. Furthermore, when we talk about the practice of spending into out years, how do we manage that? Is it okay to continue to look at spending into the out years, 3+ into the out years, 3+ years into the out years, or should we begin to look at those current years and spending that money down in current years? I think there's a lot of variables that we have to begin to look at right now. I'm reminded again that while the capital outlay is about 30% of non-recurring, 40% of that goes into those trust funds that we set up legislatively. So we're not just blowing money. We're putting money away for rainy days. It's creating that volatility to go down so that we're not having to figure out where we're going to find the money and begin to cut budgets and begin to cut programs. So I think we're doing the right things, but I think it's managing for those expectations in the future so that, man, if somebody has a phone number to Trump, tell him to stop what he's doing so that we can figure out what we're doing here in this state so that we can get our budget back in line, because I think we're on the right track. But I think there's a lot of variables as to what Chairman Munoz said earlier, that we're only 7 months into this administration. We have years left. And so how do we begin to make sure that New Mexico is safe? New Mexico is not just protected, but that we're prospering so that we can manage for the future, not just for the sake of being politicians around this table, but for the sake of the constituents back at home. Appreciate the time, Mr. Chairman.
Thank you very much, Representative Lente. Next, we're going to go to Representative Garrett, then Representative Silva. Representative Garrett.
Thank you, Mr. Chair. I just have one question, and that's as we look at natural gas, who are our major purchasers of that, and where does Mexico fit into that list?
Mr. Chair, Representative Garrett, I would love to dig in to do some research for you. Most of it actually is ending up in the Gulf of Mexico, but in Texas. And so from where it goes from there, I don't know that I've done a good analysis. So I'd like to do that for you.
Thank you.
Thank you. Representative Silva.
Thank you, Chair. Thank you all for the presentations. Those were really helpful. I have one clarifying question, and then another brief statement. But on page 13 of the report that you offered in the Money Matters, you talked about the low to high LFC scenario on the federal policy changes impacting our revenues. And Secretary Sheldon Clark also mentioned a $150 million clawback from the RRA. Is that included? Because if I add the revenue lost for the PIT and the SIT plus the RRA, that exceeds the high end of the estimate. So can you clarify that for me? Thank you, Chair.
Thank you, Mr. Chair and Representative, for the chance to clarify. It does not. These only reflect the HR1 changes. And so for that matter, it also doesn't, these tables, though, don't include any expected losses from the change in royalty rate either. So royalty rates are sort of outside of these expectations.
Thank you, Chair. And so should we, in our minds, include, like, how do I make sense of having those revenues not included, the RRA revenues? Thank you, Chair.
Mr. Chair and Representative, I would say that they are baked into the revenues. You know, all of these are included, so you don't need to necessarily take them out again. But, you know, maybe $50 million a year over the next 3 years is one way if you're trying to sort of add it up in a table in your mind.
Thank you. Thank you, Chair. And then finally, I just want to note that the State Land Office just had their highest record for their oil and gas lease sale auction this morning. And it brought in $256 million. And, you know, last month the record was $56 million. And so that goes to our common schools, that's, you know, our universities, our public schools, and that's money that's like now money. And so I'm wondering if you have a perspective on that, a point of view on that record lease sales. Thank you, Chair.
If so, and if not, we can move forward.
Happy to chat offline.
Great. Excellent. Thank you very much. Next, we have Representative Dixon and Senator Woods.
Thank you for the presentation. Always chock full of information, so it's going to take a little bit of time to process. But is there, I saw that there is predictions for the corpus of the Early Childhood Trust Fund, but do we have something that shows us what we're likely to see for the Behavioral Health Trust Fund and the Medicaid Trust Fund, since we are now diverting some of that excess revenue?
Mr. Chair and Representative Dixon, if I could have you turn to page 21 of the LFC brief, there's a Behavioral Health Trust Fund forecast there, sort of towards the bottom of the page in blue, highlighted in blue. The Medicaid fund has not yet received any money, and I think unfortunately we did not include a separate forecast for that one, but it is included. I think Secretary Sheldon Clark had a bar graph that showed small slices and how much that fund might receive, and actually it's also on our page 18 and 19, and we're expecting about half of the amount in 26, 27, and 28. So Medicaid Trust Fund, we might expect $130 million in 26, $40 million in 27, and maybe $60 million in 28. So hopefully that's helpful.
It is, to some extent. I guess the Early Childhood Trust Fund, though, is approaching $10 billion, right? And sorry, Mr. Chair. And so $10 billion is producing or providing the general fund with $500 million. So, you know, is there any chance that the Behavioral Health Trust Fund or the Medicaid Trust Fund are going to get to those levels in a period of time that's going to be useful? Because a $1 billion trust fund only spins off 50 million. And I want to make sure that as we're discussing setting money in a trust fund, that we are cognizant of the amount that it returns. Mr. Chair, and Izzy, the other thing I just wanted to flag was that on page 36, I think, this is from Secretary Chardon Clark's presentation, or Secretary Probst actually had this slide, that the table is showing that in fiscal year 30, it's estimated that the state investments, the investment income will exceed the revenue from oil and gas. Is that correct?
Mr. Chairman and members of the committee, I'm having a little trouble reading the number in that top blue bar, but it's getting very close if it's not there. Absolutely.
Thank you, Mr. Chair. Thank you, Secretary. I mean, and that is a lot sooner than I think a lot of folks had anticipated, and that's, I mean, wonderful news, particularly given sort of the volatility in other revenue sources that we're sort of experiencing. So I just wanted to highlight that. Thank you, Mr. Chair.
Thank you very much. Now we'll go to Senator Woods.
Thank you, Mr. Chairman. According to your revenue estimates, income tax revenues in 2026 declined by $197 million from 2025, and yet gross receipts revenues increased by $166 million in 26 from the 25 levels. Now, that decline in tax revenues and the gross receipt increases, that's due, you said, to taxpayers participating. Have you done anything about that participation and increased spending other than gross receipts? That's where you're showing the benefits to New Mexico is through gross receipts taxes. So that's pretty significant. And yet now the revenue estimates states that the recently adopted federal budget reconciliation bill, House number one, the House has got $206.8 million average impact on the state revenues across fiscal year 26 to 30. And these estimates include changes to standard deductions, no tax on car interest loans, higher limits on deductions for state and local taxes, which is the SALT, various business-related provisions and changes to Medicaid. But I don't think you made any reference in your estimates on the revenues impact should your legislature decide to mirror the federal tax law in terms of no tax on tips, no tax on overtime pay, or the new senior citizen deduction related to Social Security. Have you given any thought to that whatsoever, that we might decide to give those tax breaks to New Mexicans?
Mr. Chairman and Senator Woods, as usual, the consensus revenue estimate reflects current law at the time it's made. And of course, we could have future legislative sessions with tax and appropriation changes. And if those were enacted, at that point, they would become part of the consensus estimate. I hope that answered your question.
Well, I understand, Mr. Chairman. I understand what you're saying. How can we see in the future? You don't know what the future is. And yet, with these deductions to personal income tax in the federal level, there has to be some revenue incentive in the state for gross receipts. I mean, if we're giving more money to people to spend, they're going to probably spend it. And so, you know, $2,600 to each senior citizen, that kind of money, that's going to feel like a gift to them, and they'll probably spend it. Have we calculated the number of senior citizens that's going to affect, and where that money increase, that revenue increase might help us? And what I'm trying to do is offset the $206 million here is my thinking. And I know that may be plumb outside the box, and like you say, how can you do that? It's all a guess, but kind of what we're doing is a guess, right? So, Mr. Chair, if you would comment, please,
Yeah,
Madam Secretary.
and I'd love to hear from Chief Torres on this too, but Mr. Chair and Senator Woods, you're correct that there are provisions of the federal bill that will have dynamic effects on the New Mexico economy and revenues. And some of those will be positive and some of them will be negative. Like to the extent you're saying, Senator Woods, that if the federal bill puts more money back in the pockets of certain New Mexicans, they may spend that. That may drive consumption higher, which drives GDP growth, et cetera. But we've also offset that with expectations for trade war and tariffs, which are attacks on those same folks. So there are dynamic impacts. Another one that's interesting is the dynamic impact of reducing SNAP benefits makes more food deductible, which increases the state's hold harmless. There's any number of changes that are indirect impacts of that bill. Yes.
Have you, I'm sorry, Izzy?
That was, Mr. Chair, that was great. I was, changes to SNAP and Medicaid necessarily might decrease income, so there's some offsetting effects, but I think in a way we do attempt to capture it through our national forecasters who estimate the economic impact of all of those changes, which translate down to consumption, to the consumption level. And I think I just want to really flag that I don't think our forecasters have fully understood the total impact. And so we may see changes to the positive, certainly if economic activity is better because of these changes. But I also want to highlight another potential, I think we highlighted it in the brief, upside is more construction on a border wall is direct GRT for the state. And so that's a potential upside too. But there are some confounding economic impacts to income in New Mexico, and we estimate those through the general economic expectations for consumption, GDP, and so forth.
And Mr. Chair, as you say, the construction overall, we've pushed millions and millions of dollars into contractors to bid on projects, and some of those projects have increased costs by 30%, and yet that 30% we benefit through the gross receipts tax on that increase, just like if tariff pushed goods up. We benefit from the gross receipts tax on those higher costs. So, I've got mixed feelings about the tariffs on food coming into our country, but I also know it costs more to raise food in this country than out of country. We have lost our green chili production in our state due to the labor costs being so high and the rules that we have to do here. And might it be that we bring those industries such as green chili back into our state if they're on a more level playing field, which increases our income tax, which increases our gross receipts tax. I know we're not going to get rich off of green chili, but I do realize that we are importing a lot of food in our nation. Yep. And if we raise the price of that commodity, the bare commodity, that would help our American farmer to have his ability. And when a farmer gets money, Mr. Chair, I guarantee he spends it. There we go. It's a moving target to pass that right on through. So thank you for your comments.
Thank you very much. We have 5 more folks, and I'll have a couple of quick questions. So and we'll cut it off at 10. So we've got 15 more minutes. We'll go next to Representative Dow, and then Senator Padilla. Representative Dow.
Thank you, Mr. Chair, and thank you for the presentations. I'm looking at page 39, and I believe last year our budget was around $11 billion, and over $3 billion of that was new revenue. Am I understanding that even with that $3 billion surplus, we still transferred money from reserves to balance our budget?
Mr. Chair and Representative, in FY25, we do expect that an operating reserve transfer will need to be made to the spending account. The operating reserve is part of reserves, but it's in many ways a spending account for the legislature. So that's not uncommon, but to your point, yes, 93 from reserves to the spending account.
Thank you, Mr. Chair. And then I'm wondering about the 218 executive orders on the South Fork fire and the Salt Fire in Lincoln County. There's 89 executive orders in Chaves County for the floods. There is 12 executive orders on Trout Fire in Grant County, the National Guard at a cost of about $750,000 a month. I think that's well over $200 million. How do we account for hundreds of executive orders? How are they? Where are they in this budget?
Mr. Chair and Representative, you can find that on the General Fund Financial Summary, which is in both presentations, but in the LFC, it is 20 and 21. And frequently that will show up as disaster allotments coming out of the Appropriation Contingency Fund, also reserves, or the Operating Reserve, also reserves. So that doesn't show up necessarily on the line item for total spending.
Thank you, Mr. Chair. And one more question. We've created a lot of funds, hundreds of them actually, and they're for special projects and we're saving them for rainy days or whatever they may be. Have you done a breakdown of which of those revert to the general fund in tough times and what stays as earmarked for those special funds? Do we know?
Mr. Chair and Representative, really only a few come to mind. The Tax Stabilization Reserve, the Early Childhood Trust Fund, the GROW, I think now the Behavioral and the Medicaid all have provisions that allow for use in revenue declines, but they don't necessarily just automatically revert or make a transfer without appropriation. But for that matter, other funds may or may not, depending, be available to you all, whether or not they explicitly say in a revenue downturn.
Thank you, Mr. Chair. And then I would just say that, the amount of money that the state has in reserves, we are a very, very fortunate state. And it is ironic that we have the poorest population in the nation. And it is ironic that businesses are operating month to month and weeks away from shuttering. And it is ironic to me that had we made investments in generational wealth for our citizens, they'd have a little bit of a buffer for a rainy day. They'd be able to weather changes in economic crisis. So I hope that we can think strategically, and I like a lot of the ideas about switching from generational poverty to generational wealth. The common funds that we can pass on and help people out of poverty, jobs that lead to wealth instead of funding general studies. And I think there's a lot of smart people in this state who can find solutions that not only create wealth at the government level, but for the citizens that love New Mexico and call it home. Thank you.
Thank you very much, Representative Dow. Next, we'll go to Senator Padilla and then Senator Shera.
Thank you very much, Chairman, and thank you to the presenters, the secretaries, and Chief Torres. You're doing outstanding work. We really appreciate this kind of knowledge when we make decisions here. So, Mr. Chairman, I'm back on page 14, bottom left-hand corner here. You have a funds or reductions needed to meet stress test scenario. Do you have a category in there for what you already know about potential federal cuts?
Mr. Chair and Senator, that's a great question. This would be no additional federal impacts and a low oil price scenario. or at a low oil price scenario. So if you want to build in expectations for, backfilling, you could maybe incorporate that into this analysis, or maybe a better way of thinking about it is if you have a appropriation target, which the committee will develop, say 4%, the backfilling would have to be inclusive of that 4% target. So you could kind of think of it either in the reserve side or maybe on the spending side.
Okay, so Chairman, I don't think that this is going to be the only year that New Mexico is going to have to deal with this. So I hope that you maybe start thinking about how best to blend that in there and put that in the blender when you're making the cake or the whatever, okay? So please put that in there as well. I guess another question I have then is on that same line is, how much do you trust the data that's coming out of the feds right now? Because you have all sorts of things going on at the BLS. You have a number of other things. And how comfortable, I don't know if anyone wants to comment on this, but maybe Chief Torres, you could. How comfortable are we with the stuff that's going to affect New Mexico? That it's accurate and not being someone throwing something at a dartboard or something?
Mr. Chair and Senator, something we're definitely keeping an eye on. I think we're still trusting the data, and I think to the extent that we can validate through other sources is going to be useful in the future.
Okay. Yeah, and I don't want to put you on the spot or anything, but please be thinking about that, like how to validate some of this data, because these are obviously huge numbers and huge impacts for New Mexico. And then the last thing, Chair, that I'll mention, I know you have other people on your list, is when is it the best time for us to have a special session, if there is one? Because it seems like I've heard that maybe there's the potential to have one in September, but won't we have our final sort of snapshot on October 1st of what's going to come out of our federal scenario, or should we wait till after that? I don't know that we should be having a special session before we know exactly what the story is for New Mexico.
Mr. Chairman and members of the committee and Senator Padilla, discussions with regard to timing of the special session, I'm not in the room for those. I think we have a pretty good idea right now. Obviously, we have the updated consensus revenue forecast. There is, as we all know, some uncertainty as to the extent of some of the impacts from federal actions or inactions. But I think we have a pretty good handle on those as well, between your staff and the staff at DFA and the staff at Taxation and Revenue. So I don't know what data would come in between now and October 1st or November 1st or whenever the special session is that would necessarily change the numbers or change what we know.
Okay, well, that's, Chair, that's good to know then. I thought we needed to wait for some massive 900-page report to come out for us to understand what was going to happen to New Mexico. And then, so on the flip side of that, does it make sense to have that kind of a debate knowing in, say, an October or November timeframe, knowing that we're all going to be seeing all of our lovely faces, in the middle of January again? Should we be having that conversation then, or do you wish to comment on that, or would we just be complicating everything by making changes at that point?
Mr. Chairman and members of the committee and Senator, I'd go back to a point that actually Representative Dixon made. For example, if during a special session you decided to take some money and put it into the Medicaid fund now to begin earning interest instead of waiting until a regular session, bill signing, implementation date, I think an argument could be made that doing some things now would have long-term benefits. But I think you really have to be very strategic about the amounts. I think they have to be significant amounts of money if you're going to do something like that. But I do think there is some merit to making investments as soon as possible so that we can begin earning that eighth wonder of the world of compounding interest.
Wonderful. Well, thank you, Chair, and I really appreciate those comments, because I think we have an opportunity maybe to get together on a couple of other subjects for a special, and why don't we just take a stab at some of these things that we know are about to hit us straight on. So, all right, thank you very much, Chair.
Thank you. Down to 6 minutes to go, and on to Senator Scherer, then Representative Duncan. Senator Scherer, please.
Thank you, Mr. Chair. Thank you. First, Madam Secretary, you talk about, and I ask this question all the time, participation rate versus just unemployment. Is our participation rate changing any, or are we still below the national on that?
Senator Scherer, and Mr. Chair, let me find that slide where we gave those figures.
Page 12.
Thank you. And I'll preface it by saying, I'll look at this data, but I don't think that the national and the New Mexico trend have diverged significantly since our last estimate. Right. No, it's not slide 12. Where are we? Well, I'm not finding it. I know it's in my slides somewhere, but the national and the New Mexico trends are, seven, thank you, are relatively unchanged, and we do still lag behind the national labor force participation rate. Thank you, Lucinda. That's slide 7.
So, Mr. Chair, I think that that's always something to look at, okay? So if you've got 10 people in the state and 5 of them are looking for a job, then you've got 50%. But if you got the same 10 people in the state, but only one's looking for a job, well, it's 10%. So just keeping that in perspective, I think, is important. I do want to share just some thoughts here with the investment revenue. So, our permanent funds were actually created so that when we ran out of natural resources, we would have enough investment income to pay for schools. That's why it was created in 1910, okay? And then the severance tax in 1970-something, too, I think. But so this is all great. So oil and gas has dumped a ton of money in there, and now investment income is going to be at 20%, más o menos. Direct oil and gas revenue is at 20%, más o menos. But if we lose either one of those, well, then the taxes on everything else have to go up by 20%. So, and that's because the more money we get, the more money we spend. So we're not, if the idea is that we would have a flat budget if we didn't have to increase taxes when the resources ran out. So I think it's great that oil and gas has built all these funds. I also want to point out that the power of compound interest is like a superpower, okay? And we've raided our permanent funds at least twice that I know of, okay? I call it a raid, yes. Other people say, oh, no, it's raining. Okay, great. Where would we be today? That's kind of a question that's almost unanswerable, but a question, where would we have been today had we not dipped into the permanent funds twice in the last quarter of a century? By my calculations, which are not near as good as Mr. Torres's, I know, okay, shows that we would be at about 25% of our general fund could be funded through investment had we not done something under Richardson and again more recently. So we need to keep that in mind. Now we're seeing it, okay? Where would we have been before? Great, we'd have more money today had we not done it. And when we dipped into the permanent funds before because we had to solve the problem, we didn't solve the problem. Education was miserable when Richardson did it, and it was miserable when all the way from then till now, so that money didn't change anything except that it might have been valuable to us today had we stopped trying to get into it then, or not got into it then. I hope that we will now view this as real revenue and stop going after it as if it's just toy money, because it is real revenue now. The other thing that when we talk about is the volatility. Well, we've always had volatility. This is nothing new. It's not Trump's fault. It's okay. The terrible ideas that trade wars and everything's going to go up by 500% and we're all going to die because we can't afford to anything. Well, that hadn't happened, okay? In fact, nothing has happened. Other weird things, normally when you bomb places like Iran or any place in the Middle East, when there's a 2-year war going on, price of oil skyrockets, and it didn't happen. None of that happened. Something's different in the world now, okay? So I think the fear, of course, is natural for us as human beings, but I think that things are not near as ugly as it's been portrayed here, because we bombed Iran and the price of oil actually went down, not up. Okay. Of course, you know, our entire exercise there was 20 minutes. But I also think that we need to look at our entire tax policy of what we're doing. We are not overtaxed in New Mexico. We just don't know how we're taxed in New Mexico. Even Madam Secretary over here can't understand all 12,000 pages of this stuff. I think it's only 1,200 pages, but still. She's the only one that's close. And so the CPAs that are all of the industries that are looking at here going like, I don't understand this. Let's move on to Arizona or Texas or anywhere but here. So I do think that when we're talking about our revenue estimates, we have plenty of opportunities to do things. Data centers want to come somewhere. Data centers need power. The reliable power of America today is natural gas. Who has natural gas? New Mexico. So we could have data centers right here. We don't have to sell our natural gas to anywhere else in the world. We can sell it to our data center right in Farmington, assuming we had a data center in Farmington, and we were allowed to open up a power plant that could burn natural gas. I mean, if we just got out of our own way, we would sell more natural gas to ourselves than we could sell to the rest of the world. And then all of a sudden, and New Mexico, by the way, only has, by current things, about 300 years worth of natural gas at current standards. So, you know, it's going away, but I'll stop because somebody else wants to say something. Thank you.
Thank you very much, Senator Sarah. We're going to go to Representative Duncan and then Representative Adetta. Representative Duncan.
Thank you, Mr. Chair. Izzy, you told me not to worry, and so I'm not worried. We're doing fine. Mr. Chair, just a quick question. We've talked about the need perhaps of backfilling and not backfilling. Are you ready to tell us what we probably should backfill and what we shouldn't backfill?
Mr. Chair, Representative, no, but I know that the staff is working hard on analyzing that, and I'm sure you all will be getting recommendations from us in due time.
Great. Thank you. Thank you, Mr. Chair.
Thank you very much, Representative Duncan. Representative Adetta, please.
Thank you, Mr. Chair. Ismail, I'm looking at page 14 of your presentation on other forecast risks. And a lot of these things we as New Mexico legislators can't do anything about. Global conflict isn't in our lane. However, the film tax credit payments are. How much did we spend last year on film tax credits?
That is a great question, Mr. Chair. There's a whole conversation we skipped over in the interest of time, but we actually saw those credits sort of an aberration. We only had 34 million claimed in that year, but if you turn to page 9 of the LFC brief, you can see what it's been over time. You know, we had been over 100 million for a few years, and what we think happened was taxpayers who probably would have otherwise been expected to claim tax credits in the past year didn't, and they're in the pipeline. They have already been approved for those credits, and those are likely to show up in the coming year. So we think it might be, you know, close to 200 million in the next year, and that's part of the uncertainty we're talking about there.
Thank you for that, and I really do think we need to adjust those figures. I've thought that for many years, and I hope to present legislation to do that. Thank you.
Great. Thank you very much, Representative Adetta. Okay, that wraps us up. I want to take just a quick moment to thank the Consensus Revenue team. For all the economists and the team members, Ms. Fabio, Mr. Gray from LFC, and others, can you guys raise your hand one more time? Thank you all very much. This is a deeply important exercise that I've had the privilege to see refine and improve from a very strong product. The decisions that we're going to be tasked with making as we have this flattening of revenue and a much more sort of turbulent, chaotic, and challenging overall picture, particularly at the federal level, it just really reinforces how important the decisions that we work on collectively. And that's just a big thank you to the members for really great questions and digging in. Thank you all very much. Madam Secretary, we'd invite you and your team up here.
I think Garrett's
And Mr. Garrett Mosley, who knows this stretch of Las Cruces well. We're very pleased that he's part of LFC. Want to thank him for his work at HAFC this past session, and now excited with Dr. Hernandez to be here today. So, Mr. Mosley, start us off. Members, we're going to go quickly. We do have to get on the buses at 11, so I'll be quiet. We'll go through the presentations. Any questions that we have that we aren't able to address before we get on the buses, we'll make sure that we get addressed offline. Thank you all very much. Mr. Mosley.
Good morning, Mr. Chair, members of the committee. I am Dr. Allegra Hernandez, and today my colleague Garrett Mosley and I will be discussing the Early Childhood Accountability Report, which you will find in tab B, and we will move as quickly as possible. The Early Childhood Accountability Report is completed by LFC staff every 2 years and aims to understand how young children in the state are doing while focusing on front-end systems that are intended to improve outcomes for children and families. The main finding of this report is that funding levels remain sufficient and that implementation remains an issue in every topic area that we will discuss. Looking at the report, this is a unique report that the LFC does, and so I just want to take a minute to walk you through what it looks like. So the first 2 pages will go over funding and main findings of the report. And then if you skip to the 4th page, what you'll see is health, safety, if a child is ready to learn by kindergarten, and how educated they are by 3rd grade. As you can see from these measures, which were taken from 2020 to today, that we are doing about worse or the same that we were 2 years ago when this report was completed most recently. And so from that, what you can see is that as you all as the legislature have continued to invest, we aren't seeing the outcomes that were originally predicted when you chose to invest this money. And so then if you flip to page 5, what you'll see is that this is how every page looks. And from that, you will see a headline banner that has the main outcomes that are necessary for each of the focus areas that we'll be discussing. And then on top of that, we'll have a deeper dive and analysis that you are free to read on the bus, and we are happy to discuss more. So if we return back to the first page, what you'll see in chart 1 on page 1, and as I alluded to earlier, B, my apologies. So as you can see in chart 1 on page 1, you all as the legislature have made huge investments in early childhood programs, particularly in child care assistance and pre-kindergarten. In fiscal year 2012, funding for early childhood programs was less than $200 million. In fiscal year 2026, early childhood funding amounted to $918 million. Turning to page 3, if you will, you will find that early childhood programs in the state of New Mexico begin prenatally and go all the way past age 5 to age 13 for child care assistance. And today we will be discussing child care assistance, pre-kindergarten for 3 and 4-year-olds, family, infant, and toddler program, which you may also know as IDEA Part B or C, and early intervention. And then our final 2 programs are home visiting and child welfare. With that in mind, I ask you to turn to page 5. So child care assistance provides a child care subsidy for families working or going to school for children from 6 weeks to 13 years of age. As you can see in chart 2, since fiscal year 2023, families of up to 400% of the federal poverty level are eligible for child care assistance subsidy. In today's earnings, that means that a family of 3 can make $106,600 thousand and still remain eligible for child care subsidies. However, previous LFC reports have found positive benefits of child care assistance, including increasing families' earnings. Despite this, LFC staff conducted analysis which confirmed previous analysis showing that those enrolled in child care assistance were less academically prepared for kindergarten when compared to students attending pre-kindergarten, regardless of quality rating of child care center. Moreover, if you continue down the page, you will see that the New Mexico child care system has less capacity, both generally and for low-income families. Turning to Table 1 on page 6, LFC staff analysis found that statewide there are 32 child care slots for every 100 children under the age of 2 in New Mexico. Additionally, if you look at Chart 4, according to the Cradle to Career Policy Institute at the University of New Mexico, between fall 2019 and spring 2023, child care system capacity declined by 3%, mostly through the loss in registered child care homes, which saw a 51% reduction during the 4-year period. Moreover, if you look at the last column, data provided by ECECD indicates that registered homes dropped from 6,000 to 3,000 in a 2-year period. Registered childhood homes are predominantly used by families of color as they offer more flexibility, meaning they can serve non-traditional working families better. Focusing on low-income families, the CCPI report also found a 2.9% reduction in 2019 in the number of child care assistance slots being used by families with incomes at or below 100% of the federal poverty level. While broadening the eligibility pool to 400% of the federal poverty level means that more families have access to child care assistance than ever before, the additional capacity disproportionately serves higher income families in this category, meaning that low-income families are accessing child care assistance less than they did 4 years ago. This indicates that the legislature may want to focus policies towards low-income, high-risk families. Finally, New Mexico child care teacher wages remain below administrator wages. In U.S. Census data, administrator wages are ranked second in the country, while child care workers' wages are ranked 15th. Importantly, teacher pay has improved since the 2019 accountability report. Thank you. I will now turn it over to Mr. Mosley to further discuss early childhood programs.
Thank you, Dr. Hernandez. Mr. Chair, members of the committee, as previously mentioned, my name is Garrett Mosley, and I'm a program evaluator at LFC. If you will turn with me to page 7, we will examine the pre-kindergarten program. Pre-kindergarten is offered through local public schools and community-based organizations, including home-based childcare centers, and Head Starts. In the 2024 to 2025 school year, almost 15,000 children were enrolled in state-funded pre-kindergarten. Previous LFC research has found that students who enrolled in state-funded pre-kindergarten had better assessment scores, higher high school graduation rates, were held back from early grades less frequently, were less likely to be referred to special education services, and had fewer disciplinary issues than their peers who did not attend pre-kindergarten. Funding for pre-kindergarten grew by 418% since FY18, going from $52.3 million to $272 million in FY26. Increases in funding have resulted in more children being enrolled throughout the state, with nearly 3,000 more children enrolled in FY25 than FY19. Looking at Chart 6, you will see that LFC staff estimates that if 5,000 more low-income students participated in one of the highest performing pre-kindergartens, approximately 2,000 or 10% more students would enter kindergarten proficient in reading. If you turn to page 8, you will see that New Mexico pre-kindergarten faces large disparities in teacher preparation between school-based and community-based providers. In the 2022 to 2023 school year, 96% of school-based pre-kindergarten teachers held a bachelor's degree or higher, while only 31% of community-based teachers did. Peer-reviewed studies and prior LFC research indicates teacher education level matters when it comes to early childhood educational outcomes. As pre-kindergarten continues to expand, strategic implementation is needed. If you turn to page 9, you will see a map of each school district in the state, noting the number of pre-kindergarten slots available to 4-year-olds. While about 80% of the state's 89 school districts serve more than half of the 4-year-olds within that district, roughly 20%, mostly rural districts, served less than 50% of 4-year-olds in FY24. If you will now turn to me to page 10, we will examine the Family Infant Toddler Program. The Family Infant Toddler Program, or FIT, provides early intervention services for children from birth to age 3 who have or may be at risk for developmental delays, disabilities, and serious medical conditions. The program works to limit future intervention required based on a child's delays and is projected to serve nearly 17,000 children during FY26. For FY26, the state appropriated $76 million for FIT, an increase of 22% from FY25. FIT operates at no cost to families in New Mexico, regardless of income level. Between July 2024 and May 2025, 70% of participants received Medicaid. However, the state may be slightly underbilling for Medicaid, meaning the state is losing out on crucial federal dollars. Under FIT, states have the option of adding an eligibility category for children at risk for developmental delays. The percentage of children, and if you look at Table 3, you will see that New Mexico is the second largest state for enrollment for at risk. The percentage of children ages 0 through 3 enrolled in FIT grew from 7.9% in 2022 to 11.2% in 2023. The increase in enrollment may indicate New Mexico's under 3 population is becoming more at risk of having developmental delays, or that ECECD is enrolling eligible children who had not been previously enrolled. Further monitoring is needed to better understand the increase in enrollment and FIT within the state. If you turn with me to page 11, we will examine home visiting. Home visiting is an educational program for expecting families and families with children under 5. As Table 4 demonstrates, ECECD offers 7 different home visiting program types, each with a different completion timeline depending on family need and interest. Depending on the program, benefits include improving maternal and child health, school readiness, economic self-sufficiency, positive parenting practices, and a reduction in child maltreatment. In FY25, the state spent $51 million on home visiting, and in FY24, 7,775 children were served. New Mexico's rates of home visiting completion are significantly lower than the national rates. While low completion and duration rates are a problem nationwide, national research shows that when families stay in home visiting for the expected length, they are more likely to get greater benefits. Examining Chart 9, you can see that only 13% of families who left the home visiting program had completed the program. Completion rates doubled in FY24 compared to FY23. However, child maltreatment rates for families enrolled in home visiting increased from 0.62 in FY21 to 1% in FY24. Although there are several factors that may contribute to this increase, it is important the state continues to monitor how providers deliver home visiting to ensure it is delivered as intended. Thank you. I will now turn it back to Dr. Hernandez to conclude with a discussion on child welfare.
Thank you. Turning to page 12, New Mexico consistently ranks worse than the national average in key child safety statistics, in some cases by significant margins. Infant maltreatment in the state is 47% higher than the national average, and the child maltreatment rate is 70% higher than the national average. Additionally, looking at Chart 10, you will see that repeat maltreatment rates hover around 15%. This leads to significant recommendations focused on evidence-based programs. Looking at Figure 2, within child maltreatment prevention, secondary and tertiary prevention strategies are aimed at families with great risk factors. During the 2025 legislative session, you all made significant reforms to the child welfare system to encourage preventative strategies by passing Senate Bill 42. Implementation of both Family First Prevention Services Act, or the FFPSA plan, and multi-level response would help to address repeat maltreatment. New Mexico does not have an approved FFPSA plan, despite CYFD initially submitting a plan in September 22. Absence of an approved plan by the federal government makes New Mexico ineligible to receive federal funding to implement evidence-based programs in the federal Title IV-E clearinghouse. Additionally, LFC analysis suggests the state may experience cost savings ranging from $4.9 million to $10.8 million due to the implementation of a multi-level response system, if implemented with fidelity to evidence-based models. National data demonstrates that 14% of cases screened by Child Protective Services use differential response or multi-level response. In 2022, CYFD accepted 20,000 reported cases of abuse or neglect. If New Mexico were to refer 14% of the 20,000 cases to an alternative response instead of an investigation, roughly 2,800 cases would receive an alternative response. Through the passage of SB 42, you all, as the legislature, required both an FFPSA plan and multi-level response implementation statewide. Returning to page 2, you will find the key findings of this report. Ultimately, LFC analysis indicates that funding levels remain sufficient and that implementation remains an issue across the board. Thank you.
Thank you very much, Dr. Hernandez and Mr. Mosley. Madam Secretary, we'll turn over to you.
Good morning, Mr. Chair, members of the committee. I am thrilled to be here with you today. Thanks to the bold vision of Governor Michelle Lujan Grisham and the bipartisan leadership of the legislature, New Mexico is leading the nation in building a universal, family-centered, high-quality, community-based early childhood system that is improving school readiness, enhancing the health and economic well-being of families, and strengthening our communities. We have made tremendous progress. At the same time, our early childhood system is still clearly a work in progress. We have gaps to fill and work to do, as you just heard from Dr. Hernandez and Garrett. New Mexico partnerships among the legislature, the governor, the children's cabinet, and most importantly, our families, early childhood providers, and professionals form a very strong backbone of this system. ECECD builds on our state's long history of early childhood innovation, leadership, and our state's core values of family, culture, language, and community. These pillars guide us in expanding access to services, ensuring children are ready for school, holding ourselves accountable for results, and elevating early childhood professionals. I appreciate the Early Childhood Accountability Report from the Legislative Finance Committee and its focus on quality and data. In childcare, we are redesigning our focus program to zero in on the key factors that support school readiness. As part of the redesign, the department is introducing the classroom assessment scoring system measure, which we also use in pre-K, which helps us know how well things are going for children and their teachers and supports improvement. Likewise, the report also highlights the need for lead teachers in pre-K to hold early childhood degrees and credentials. We share this priority, and ECECD is working to expand workforce credentials alongside strengthening targeted supports to help educators put early development principles into practice. I'm also pleased to see the report's focus on data. We are working to improve our data systems and infrastructure, and later I'll share with you our new data dashboards. These dashboards provide firm evidence of our progress and reflect our commitment to using reliable, up-to-date data to guide decisions and drive improvement. I want to be upfront that ECECD has had to build its data and accountability infrastructure from the ground up. We're grateful to the federal funding that has supported this work, as well as one-time investments from several national foundations that have made this possible. At the same time, while the data show real growth, I want to stress that every program we offer to families is voluntary. Families choose to participate, and the strong uptake demonstrates the value of these services and how responsive families are to them. Your continued investment in early childhood is what makes all this growth possible. On the second slide, the next two slides, I just wanted to share, as I did 2 years ago at the biennial report, New Mexico's innovative work in early childhood is drawing national attention almost every day. The eyes of the nation are on New Mexico, and this coverage underscores that our state is not only making progress for New Mexico families, but truly setting the standard for the country in what families and young children need and deserve to grow and develop and to thrive. The slide 4, I hope our slides are numbered. Yes, they are. Yes. To just summarize and emphasize, as you've all seen this vision and mission many times, that all New Mexico families and young children are thriving. That's the vision of this department, and our mission is to optimize early health development, education, and well-being, and this guides everything we do at the department every day. This next slide, on slide 5, talks about our key areas of system focus for greatest impact. This comes out of a document and a publication from the Administration for Children and Families. And what I want to emphasize here is that when Governor Lujan Grisham and the legislature created ECECD, they charged us, you all charged us, with building and fostering New Mexico's early childhood education and care system. You had the foresight to do this and the wisdom to include an Assistant Secretary for Native American Early Education and Care as a key leader in this system work. By system, we mean a coordinated network of programs, services, and partnerships. This network includes public and private providers, tribal partners, health and family support services, workforce development, and community-based resources. This system is built on inclusivity and equity. We work in true government-to-government collaboration with the 23 nations, pueblos, and tribes. And we know success requires more than just delivering services. It requires aligning policy, funding, partnerships, workforce, and the infrastructure to drive better outcomes for children and families. At the heart of this system are high-performing programs, pre-K, home visiting, early intervention, and childcare, delivered by a strong and supported workforce. These professionals are key to the quality. That is why workforce development, fair pay, and strong benefit remain top priorities for the department and this administration. Equally important are the connections that make this system seamless for families. We are strengthening linkages so families don't experience a patchwork of services, but rather a clear path of support that meets their needs at every stage. Behind the scenes, infrastructure makes it all work. Data collection and analysis, accountability systems, financial modeling, and surveys of families and providers give us insight to how to improve and sustain quality. Just as important, families, providers, and communities are at the table, shaping decisions through our advisory groups, coalitions, and engagement strategies. And finally, scale. Our vision is universal access so that every family in New Mexico who wants or needs early childhood supports can access them. Part of the governor's cradle-to-career education system. With the governor's leadership and your partnership, we are moving steadily towards that goal. You'll see when these pieces, context, components, connections, infrastructure, and scale come together, New Mexico's early childhood system will deliver and is delivering better health, stronger achievement, and brighter futures for our children. And in doing so, it strengthens families, communities, and our state's economy. That is why this work matters and why your continued leadership and investments are essential. Slide 6 shows where we're going and where we've been. You'll see there that as we started in 2021, that was the first fiscal year of ECECD, we have grown substantially in reaching more children, as well as what the LFC report has shared with you. Each color represents a different core program: New Mexico Pre-K, childcare, fit, and home visiting. You can see the improvements we've made in terms of access, and especially, again, for New Mexico Pre-K and childcare, and where we want to be in 27. So for where we came in 21 with only 33% of our children 0 to 3 in childcare accessing that assistance, we want to see that at 77% in 27. Slide 7 shows you what will be needed in order to address that. Dr. Hernandez shared that in terms of infant and toddler slots. We just completed a supply and demand study that shows exactly that. We need 12,000 more infant and toddler slots in almost every community across New Mexico. We also need a workforce, and we are attracting incredible talent into the early childhood profession. We need to grow that workforce by about 1,500 professionals. And we want to expand to nearly 29,000 slots by 27 for our infants and toddlers, families who want to go to work, need to go to work, want to go to school, pursue their dreams, have this significant barrier when it's not available in their community. So reaching universal access so that New Mexico families can find and afford quality early education and care is clearly ambitious, but it is achievable if we continue to work together and invest in the workforce and the facilities that families want. The next slide just shows you a testimonial from Toby Lee, a home visitor in Gallup, and her story reminds us why the early childhood workforce is so vital and why public investment matters. On slide 9, I want to talk about and emphasize accountability and transparency. I know, and you all know, that accountability and transparency are essential elements of this work. These practices help us to build public trust and ensure that we deliver on our mandate of school readiness. Transparency looks like our new public data dashboards, which you'll see in a minute and you can access yourself from your computers, and county fact sheets. Each of you in your packet have customized fact sheets. I want to thank Vice Chair Munoz. 2 years ago in Las Vegas, you said, why don't we have fact sheet? Why don't we have information about our programs? And it was that idea that germinated the county fact sheets, which have been updated. We also want to make it easy for you as legislators, for communities and families. What is happening locally? Accountability means that we are using reliable, evidence-based tools to measure our school readiness outcomes. School readiness includes social competence, emotional maturity, general knowledge, physical health, and language and literacy. Some of the accountability tools that we're using, as I mentioned earlier, the classroom assessment scoring system, which has been used in pre-K for the last 3 years, is now expanding to childcare in this coming year. The early development instrument and the childhood early questionnaire experiences we have administered to kindergartners in partnership with the public education department. It's done by kindergarten teachers or it's done by parents of incoming kindergartners. Again, these tools focus on the full readiness of children, their full social competence, emotional maturity, general knowledge, physical health, and language and literacy. You also have customized EDI reports in your packet for counties that you represent. And in the slide, you can link right to now the interactive EDI maps and zero in on a neighborhood, a part of your community that you want to see how young children are doing in each area of development. Data from these measures are going to help us identify strengths, address gaps, and drive ongoing improvements across the system, ensuring every investment moves us closer to better outcomes for children and families. On slide 11, you see a glimpse of a data dashboard that we began. When we began in July 2020, we had fragmented programs and limited alignment across services. Access to quality care varied by region. Infant and toddler care was in short supply, and workforce wages were often below a livable standard. Data systems were not fully integrated, making it difficult to track outcomes and ensure equitable access statewide. We have come a long way, and we're pleased to share these data dashboards with you. On slide 12, you'll see the data from the Early Development Instrument. We collected this for the first year in 2024, and we're gearing up for another collection in spring 2026. The EDI data gives us all a clear community-level picture of how children are doing across all areas of development. EDI supports turning data into action. EDI results are localized. Communities can see their own data. That empowers local leaders, educators, and families to design solutions that respond directly to the needs of their children. And at the state level, we can see a lot of what we can be proud of in terms of overall percentages of children on track and more work to do so that every child is on track across all school readiness domains. Slide 13 shares with you the department's current priorities. Our system has many elements, and there is a lot to discuss with you, and we are short on time. But we are especially focused on 4 strategic priorities that we know will help ensure progress remains sustainable and that assists us in addressing the key gaps outlined in this report. Universal access, ensuring every family can access affordable, high-quality early childhood services regardless of income, location, or language. Workforce stabilization and growth. The early childhood workforce is the heart of this system, so ECECD must implement strategies that help recruit, retain, and fairly compensate early childhood professionals. Expanding the quality supports a robust set of quality support so that children have high-quality experiences every day in their early education and care programs. Family engagement. When families are active partners in their children's learning and development, we all know that outcomes improve. I just want to recap, and I'm closing, Mr. Chair. I know we're short on time. New Mexico's early childhood system is stronger, more connected, and more transparent than ever before. Quality, access, and accountability are the foundation for school readiness and long-term success. Strategic priorities focused on universal access, a strong workforce, consistent quality standards, and engaged families is critical. We invite the Legislative Finance Committee to continue its positive partnership with ECECD, support transparency, invest in proven strategies, and hold us accountable for delivering results for New Mexico's youngest learners. ECECD is also incredibly grateful to our tribal partners for their ongoing leadership, innovation, and engagement in early childhood policy and investment. I would like to, if I could, just introduce the staff who traveled here with us today from the ECECD Executive Leadership Team. Our fairly new Assistant Secretary for Native American Early Education and Care, Dr. Joni Sweeney. Brand new, as day 2, our new Deputy Secretary, Kendall Chavez. And Director of Communications, Sonia Martinez, is behind all our great communication. Director of Early Care Education and Nutrition, Sandy Trujillo Medina. Director of Family Support and Early Intervention, Allie Hedrick. And day 2, our Director of Policy, Research, and Quality Initiatives, Dr. Haley Hines. And our Deputy Division Director and Head Start Collaboration Director, Casey Lafferty. And our General Counsel, Shelley Strong. And I just want to thank you all for your time and appreciate all the investments and the work that we have collectively done to improve the lives of New Mexico families and children.
Excellent. Thank you very much, Madam Secretary. Thank you to your team. Thanks to our 2 evaluators. The one piece of information that I'll be super interested in is understanding, particularly from new families and new families to be, and even new moms and new dads, new families, because we know the infant care is the most challenging. It's the most expensive. There's the most risk associated in a bunch of different ways. If those families and those moms in particular, but the families, had several months of funding to stay home with their kiddo, if that's something that those families want, if that's something that would be a benefit, because it seems like for us to provide all of the infant slots, we're going to be paying a really incredible premium as a state, because those are the hardest slots, the most expensive, the hardest to get. We're lagging in that right now. Would it not be quicker and more efficient, and in fact serve families, and I've heard this from colleagues a whole lot, serve families even better who want to stay and be able to bond with their kiddos, and if their professional circumstance doesn't provide for that, or even if it does, the state considers support on top of that as a way for all the kiddos who are being born, the new families that are becoming families, if that's something that we should consider. I don't know if you have any. I would just put that out as something I'm really interested in as we go through. And thank you thank our evaluators. Thank you, Madam Secretary. Then go to the next set of questions, which starting with Representative Dow, then Representative Chatfield.
Thank you, Mr. Chair, and thank you for the presentation. I have to give a little bit of context because this is something that I know a lot about. I grew up in Truth or Consequences and came back in 1999 to open the first licensed child care center in Truth or Consequences. And at that time, we were reimbursing more for a stray dog at an animal shelter, the state was, than we were paying for infant care. So there is a lot to celebrate and a lot to commend ourselves for. My major had been business, but I came back to visit my parents, and I'm in this community, still one of the poorest counties in our state, where the people, I have to clarify because the government's not poor, where the people are the poorest in the nation. And the cost, quality, and outcome study had come out on child growth and development, brain development. We were learning what was happening and that children were learning 80% of what they learn in their life before the age of 5. And I am proud to be part of early childhood before early childhood was cool, because I wanted to see positive changes in my community where they weren't happening. And some of the things that we need to celebrate, these are not little things, because families entering these programs are now insured, they're having well checks, their children are on track with their immunizations, they are in a community of experts and allies in their child's success. That alone is something to celebrate. And to be part of an early childhood system that ranks in the top 20 in the nation is when top 5? Oh, okay, top 5 in the nation is something we should celebrate. I will tell you, I'm getting increasingly frustrated at the cost we're investing in this. And I'll tell you, it's because the studies that justified this, 1, targeted low-income at-risk families, and our state has chosen universal. 2, the biggest gains would be for the families that need it most. And that child welfare report and the CYFD presentation yesterday at Health and Human Services, if that doesn't break your heart, we have too many infant fatalities, and the families that would benefit most from these programs, they remain voluntary, and they're the ones that are engaging the least amount. There will never be enough money if we go universal. You mentioned we need 12,000 more infant toddler slots. How much of that has to do with the new caps that we're putting on classroom sizes, Madam Chair, Mr. Chair, and Secretary?
Mr. Chair, Representative Dowen, thank you. Thank you so much for your leadership all the years around early childhood. We have not implemented lower ratios in group size at this point, but as we shared during the session, I think that was about 800, if in fact the state moves forward in that way, 800 slots. So it's not, I think that the issue here is that there's so much need, but there's also amazing, as you know, childcare providers who are ready to serve, who have expanded their businesses and are interested in expanding into infant and toddler care. So I do agree that families need options. That's what is so important about the early childhood programs, are that they're voluntary. Our family survey we do every year shows that 89% of families feel that their overall well-being is improved because they have access to childcare and other programs. So you're right, it's a big lift, and it's important that the facilities that we create are of the highest quality. And I think you would be the first to know that it's those ratios and that interaction between the educators and the children that help make that quality happen.
Mr. Chair, I know we're limited on time, Secretary, so very brief answers, I'd appreciate it, because I have a lot to say about this. It's why I ran.
Yep, exactly.
It's why I serve. Mr. Chair and Secretary or committee panels, yes, you're talking about ratios. Not only are you looking at reducing ratios, you're also looking at capping classroom sizes. So it's two different things. They're distinct and they both have an impact. So when we focus on universal access to slots and we prioritize universal access to slots at a rate that is exorbitantly faster than we're graduating any professionals, that we're able to offer professional development, we shouldn't be surprised when we see a decline in the quality of our staff, because we're not training them at the rate that we're growing slots. That's just a fact. We give waivers to CYFD on social work. I think less than 4% of our social workers, I know this is the child welfare page, it's not necessarily you, but we've got more social workers and home visiting programs than we do at CYFD, and the home visiting programs are voluntary. So we're making good investments, but we're not putting them all where the evidence-based outcomes could have the greatest impact. So I'm concerned about this rethink. I know that over 200 people came to the Early Childhood Advisory Committee and over 100 on the follow-up, very concerned about the change of Star 5 on accreditation, moving those accredited programs. These are our beautiful community-based programs that were the demonstration models for all this expansion, to be moved to Star Level 4. Have you rethought that? And why aren't you working with the accrediting bodies to more align with what you're looking for than just eliminating them as the highest level of quality?
Hi, Mr. Chair, Representative Dow. So the accreditation conversation is in process, and it's if the accrediting body meets the criteria of the focus redesign, the state will absolutely consider it as a 5-star. So those are that has been shared through the subcommittee and through the advisory council, and so that is still under consideration. And in our September meeting in Silver City, we'll be talking with the advisory council about that. And as this report showed, quality did not seem to indicate better outcomes for children. And so I think it's something that, talking to Director Salih and others as we make these investments, what are we buying, and what is that investment giving back into the state? So I think it's a good question, and the crosswalk has to happen under the focus redesign with the 7 accrediting bodies that the state currently accepts as a 5-star.
Thank you, Mr. Chair, and thank you, Secretary. I would just note that Montessori is not part of that. Waldrop's not part of that. They're already excluded from one of those 7 accrediting bodies. And I think when you talk about community and parent choice and voluntary access to a variety of types of programs, that this would take us in the wrong direction. So I just want to have, if this body only focuses on one page, page 4 and 5 of this handout is pretty telling. I mean, I'm going to go to Sierra County, which has less than 34% of adults have a high school diploma or higher. Yesterday, the Medicaid report showed that over 70% of the folks are dependent on Medicaid or SNAP or some sort of government assistance. And this is saying that 49% of those kids from the most at-risk families in our state, one of the 3 most at-risk counties, that 50% of them are developmentally on track on every developmental area. And then 30% are at risk in one area. That's 70%. I don't think the K-12 system has been able to say that for a very long time. And when you look at the number of children that are unfit, most of them might have an IEP. I don't know what more you want from these providers. I don't want to take up any more time, but I do want to be on the record saying that I would like a separate meeting with you. I've not gotten this many calls from parents, providers, early childhood experts across the state expressing concerns, whether it's fit, home visiting. I mean, there is a lot of concerns about this big pivot, and I would like to meet and get some follow-up. But I want to be on the record because there is no amount of money that we can spend to reach these goals. So if public school had kids in each grade at 70% proficiency, we'd probably all be shouting from the rooftops in this room. Thank you.
Thank you very much, Representative Dow. Next, we have Representative Chatfield.
Thank you, Mr. Chair. I start off by complimenting the Secretary on what she's done. What she's done well. There is no way to separate her job completely from CYFD. In my mind, and I see we're worrying about a lot of the same children. So forgive me if some of this does not fall under your purview, but I think it bears bringing up right now. And as I look at our report, the staff report, I'm looking at page 4, and it says infant mortality is worse. Low birth weight is worse. Rate of babies born substance exposed is worse. Early access to prenatal care is the same. Abuse or neglect deaths is worse. Rate of child maltreatment is the same. Rate of foster care placement is worse. Repeat maltreatment is worse. And once again, I want to say I'm not pointing at you. I think a lot of this comes under CYFD, but I know you have some overlap. I'm hoping maybe you can help us out with this, okay? That's the reason I'm bringing it up. We have to do something about this. Reading, which would be the older kids, is a little better. Reading low-income kids is better. So after the kids kind of get their feet under them, most of these things are better. Math is worse. Rate of children under 5 is in poverty is a little worse. I would just call this out to bring attention to the fact that our youngest kids are struggling. I might have some things in common with the chairman, that maybe there needs to be something additionally put in there for those very young families, especially the CARA families. But I would add to that, I don't think it should be a freebie. I think it should be mandatory. That if you are addicted to drugs and you have a baby, then it's no longer your freedom. You have another little life and another little responsibility that you have taken on. And I think that our CARA mandate should be a mandate. I think it should be not a choice, but a mandate. And I also believe that there needs to be an enormous revamping of CYFD, which you well know. I have worked with them as a treatment foster care provider. I'm very familiar with the institution and the process. But I do think that we have a problem in New Mexico, and that's drugs. It's fentanyl and it's other drugs. And that is spilling over into our children and our children's future. And we need to stop it here. And we need to provide those children with what they need to become healthy, productive members of society so that we stop this hereditary drug abuse, poverty cycle. We need to shut it off now. Thank you for your time.
Thank you very much, Representative Chatfield. Next, we have Representative Garrett, Herrera, and then Lente, and then Senator Tobias. We'll keep going again. We're going to wrap up at 11. Thank
you, Mr. Chair. And give short answers. We can get longer answers offline. First, in response to what Jack Chatfield just said, I sometimes think what we need is not financial planning for high school, but family science and care, so that we can cut off some of these problems before they start. On page 13, you mentioned that the Family First Prevention Services Act still hasn't been completed, and we're now 3.5 years. Can you give us any kind of update?
So, Mr. Chair, members of the committee, as far as I am aware, the FFPSA plan has still not been approved by the federal government.
Thank you. And then what is the impact? The federal government said they don't want to have undocumented children in Head Start. Is that affecting us? Any update on that?
Mr. Chair, Representative Garrett, we work closely, our Head Start collaboration director with the Head Start Association, and at this point, there have been different, it has not impacted right now because they don't collect information on children, on children's status. So there's been some reversal, and I'll get you the exact update, though. That's been some emails going up the last week or so. But so far, our Head Start programs are staying strong, and they're serving all the families.
Thank you. And Mr. Chair, on page 5, it says that child care center star level ratings do not contribute to a child's likelihood of being determined proficient when testing for kindergarten language arts abilities is done with iStation, my pet peeve. Is there any effort to test them in 3rd grade? Because many of our STAR centers focus very much on the whole child, and I would be interested to know how that whole child tests a few years later. Any effort to extend that?
So, Mr. Chair, Representative Garrett, as of right now, we have not done any analysis with 3rd grade. However, excuse me.
Representative Garrett, in the 2019 child care evaluation, I believe we did look at 3rd grade proficiency, and we did not see any significant impacts in regards to STAR level on child proficiency.
Okay, thank you. And Mr. Chair, my last question is, we're embracing the Dolly Parton Imagination Library 0 to 5, and I think if we can study the impact of that, because playing with books is very significant. That's just my final recommendation. Thank you.
Thank you. Representative Herrera, then Representative Lente, then Senator Tobias.
Thank you, Mr. Chair, and thank you all for your presentation, and thank you for all of this information. It'll take some time to go through that, but I deeply appreciate all the work that you've done in providing facts for us to understand. For those of you who don't know around the table, the Lionel Foundation, when I was director, we started the first home visit study on home visitation over 20 years ago. The state gave us, we raised $1 million. The state gave us a matching $1 million to do a 5-year study on home visitation, which we did, and we found the firstborn program to be a commendable program. I would like to say that the state still uses firstborn, but you should know that local providers have complained that, they'd love to use firstborn, but the state reimburses, the state really recommends the families first because we get a Medicaid reimbursement on that. Do I get that? Yes. But I still have problems with accepting federal money that limits what we can do, especially when we have money. But I will go on from there and just ask a few questions. I'm curious what you mean by completion in home visiting. What does completion of a home visiting program mean?
So, Mr. Chair, Madam Representative, Representative Herrera, if I could actually first turn you to page 11, to the third paragraph, what you'll see is that firstborn, to your previous point, is currently being studied in a multi-year study to see if it can receive Medicaid reimbursement. So that is in the works. It obviously is not going to happen immediately, but just so that if you were not aware, so that you are aware. The second thing that I'll say is that how home visiting completion rates are defined is by the home visitor. And so if the home visitor determines that, if a family says we want to stop and a home visitor determines that they have completed the program, then that is when they are considered completed versus, so if a program is 5 years and a family stays for 3 years but the home visitor and the family both mutually determine that they've completed the program and have received what they needed out of it, then they would be considered as completed.
Can I just jump in for a couple points of clarification? So in regards to the multi-year study, that is to look to see whether firstborn could qualify for MCV funding, and if it was able to qualify for MCV funding, then in the future we could potentially petition the federal government for Medicaid reimbursement. In regards to the completion rates, those are determined by the home visitor. So at the end of when a family says, I no longer want to enroll in home visiting, the home visitor determines whether they have completed or not. But that length is not necessarily 5 years. That is dependent upon the type of program as to what the appropriate length for the home visiting may be.
Well, I would like to add, Mr. Chair, that when we did, I had the RAND Corporation do the study on our home visiting program, but there's a lot of politics based on that's a whole other conversation, so I won't go there. But what I want to say is, if you have a pregnant teenager in a home visiting program, firstborn used to say 3 years, and they used to really work to keep those kids in the program. Obviously, they needed much more counseling and help. And I asked the founder of the program why they stopped at 3 years, and she said, well, we just stopped at 3 years because then we knew they could go into a preschool situation or pre-K, and we felt that that family would be taken care of. And it's just kind of common sense. She said, for a family that's what do I want to say? A family that's kind of got it together, they found that every family could use services for about the first year. That it was, when you have a newborn, and every baby is different. That's what you need to know. Every baby is different. But when you have a newborn, probably pre-pregnancy, pre-birth, and that first year are the most important times. And most families could just, kind of gently go off because it takes a lot of time. It's an hour a week, guys, to do this. So it's a real commitment. So after that first year, families that were kind of well situated would be just fine going off the program, and they would call. They could always call their home visitor in 2 or 3 and say, hey, here's what's going on. Can you tell me something? And that home visitor would be prepared to give that answer. So I honestly think that 5 years is a long time for home visiting and very costly. And so I would recommend, I mean, that when you look at this, that you, has anybody kind of looked at that, that completion rate process at a national level or a local level or a state level to say what works best?
Mr. Chair, Representative Herrera, thank you, and thank you for your great leadership on home visiting over the decades. And we have actually taken it on since the LFC report on home visiting. We're looking at this. We have worked with the home visiting provider community, and again, it goes to this issue that they pointed out in the report, and that we agree. Better data, better use of accountability and transparency in what's happening for families. So we can get with you, because we just have updated definitions and processes around the issue of completion. So.
Well, that's wonderful, because I noticed in the report that your completion rates went from 22% down to 13% last year. And first of all, I didn't understand what a completion rate was, or can you tell me why that lowered?
Mr. Chair, Dr. Densis.
Mr. Chair, Representative Herrera, the completion rates did go down from 22%, but I believe that was in 2020, and then they have now gone up from 7% in FY23 to 13% in FY25. So there's been an almost doubling for the last few years.
I mean, thank you,
And we're going to thank you. We'll please finish up. We're going to we'll go a couple of minutes, but any other questions we're going to have to go
that
offline.
was the last question I had, Mr. Chair.
Great. Thank you very much, Representative Herrera. Representative Lente, anything briefly, and then Senator Tobias, and then again, we'll make sure that staff and Madam Secretary, if you would, with your team, will continue the discussion offline.
Yes, sir, Mr. Chairman. Thank you. Very briefly, I want to first thank the staff for ECECD and all that you've done to make sure that our most vulnerable, regardless of their geographic location in New Mexico or their family's economic status, are protected and promoted in ways that will benefit them in their outer years. I have one question, but first a quick comment, Mr. Chairman, that I want to once again just appreciate the work that you've done in a quick time frame from many of the tribal nations that I represent. And mind you, that my district is very much Native American New Mexico, and you keep making mention about your appreciation for the tribal partnerships that we have. And I have to also commend your former Native American Secretary Sneddy, that was here before, because she laid a lot of the groundwork that I worked closely hand in hand with her in developing those types of policies. And in doing so, it really represents the turn in regards to how policy for early education or education for Native students has evolved from what once was a reliance on federal policies that was the Head Start program, right? We had to adopt Head Start program because that was our only venue to provide any type of early childhood education for our students, right? But in Native country, it was Head Start, but we didn't know what was a Head Start 2. And the Head Start to many of those programs was an assimilation of our Native American cultures, languages, etc. And so when I worked with former Secretary Sneddy on a lot of these policies, it was a matter of making sure that it was not an assimilation process, but it was one that was based on making sure that those tribes had the ultimate authority to determine what was best for their students and how the practice and policies and what they were going to teach in those programs were to best fit those programs. So I appreciate that. And I will also want to commend the programs for, once again, partnering with the capital outlay process, with PED, with the administration, and with this legislature to making sure that we have the on-the-ground facilities to promote and continue to promote these types of programs. And I will say that in this year alone, we will open up new early childhood facilities in Santo Domingo Pueblo, Kiwa Pueblo, in Sandia Pueblo, in Zia Pueblo that already opened. And so those are huge accomplishments that had never had that type of appreciation for anything related to their early childhood care programs. One quick question, Mr. Chairman, is based on ECECD's total budget, is there a certain percentage that is to support early education for tribal nations?
Mr. Chair, Representative Lente, thank you, and thank you for your leadership in helping support the department with the legislation that you passed. We have now a little over $6 million that's dedicated just for that piece of tribal investment strategy, we call it. So government to government, what are the priorities of the presidents and the governors? In addition, though, this year we expanded. I mean, home visiting, pre-K, all those programs, their budgets go directly to tribes. We now have 9 tribal governments running their own pre-K programs, up from just a couple when we started. So the $6 million is just that dedicated funding to come to do government-to-government collaboration, but then all the budget of ECECD is available to our tribal communities.
Thank you. So, Mr. Chairman and Secretary, so that's just a portion of your entire budget, right?
Correct.
But it's not exclusive to a certain percentage of your entire budget.
Correct. Mr. Chair, Representative Lente, correct.
Thank you, Mr. Chairman, and thank you, Secretary. Again, I appreciate you, and I look forward to working with your new Assistant Secretary for Indian Education in your department. Thank you very much.
Thank you very much. We'll close with you, Senator Tobiasen.
Thank you, Mr. Chair. Okay, so this was a lot of information for me, and I'm learning every time that we have conversations centered around child welfare. So I think, if I remember correctly, LFC reported that we're number 1 in the country in our spend on early childhood development and number 15 in provider pay. I do remember in the session that was a conversation you had with us that we need to be paying providers more. It seems like we have accomplished that because those are 2 of the highest national rankings I've seen for anything in the state. That being said, the money that we're spending, really looking at the outcomes, we're not there yet, right? And if I'm looking at the rates of maltreatment, I think it's on page 12, chart 10. We're at an uptick of 15%, and it looks like we almost doubled in maltreatment of children in home visiting. Am I on target there?
So Mr. Chair, Senator Tobiasen, it did increase. If you look at page 11 in the banner, the substantiated maltreatment referrals during participation of home visiting didn't quite double, but it did increase from fiscal year 23 from 0.87% to 1%. And there are 2 possible reasons why that occurred. The first is that child maltreatment rate across the state has just increased. The second is that home visiting is actually doing what it's supposed to, and that home visitors are finding maltreatment. And so we really need further work to better understand why that number increased.
Thank you. And Mr. Chair, then it seems to me that we should be focused more on targeted approaches versus universal, because we're challenged specifically, going back to what Representative Dow said, with the poorest people in the nation. And something else that I'm very focused on, you may be aware, is the fact that we're number 1 in adult illiteracy. There has to be a direct correlation to that. So who is in charge of figuring out, like, children in foster care? So are they automatically enrolled in home visiting if a child is in foster care and under 5?
Mr. Chair, Senator Tobiasen, they are not. I will, however, point to certain models of home visiting reducing child maltreatment rates. And so if you look at nurse-family partnership, you see on average a 5 to 8% reduction in child maltreatment, versus if you look at a different program, either the effects are unknown or they are much smaller. And so there are targeted home visiting programs that do focus on reducing child maltreatment.
Okay, and Mr. Chair, though, specifically with foster care, are you involved in that, and why wouldn't these services in the home visiting be required?
Mr. Chair, Senator Tobiasen, so we work very closely with CYFD and the protective services, and that's part of that linkage is the work of the department being able to make sure that those families are connected. To the point, can we do more? Can we do better? Absolutely. But through the Children's Cabinet, we have a number of strategies around the exact point you're making. Is These programs have been voluntary. That's how just traditionally in our country, they have been voluntary. And so I think we're hearing a lot from the legislature about this need for mandated. Clearly in Senate Bill 42, there are some mandates. But I think the importance of our departments, the Children, Youth, and Families Department and ECECD, having those deeper linkages and connections is going to get at exactly the point you're making, and we agree with, and so does Secretary Casados.
Thank
Great.
you.
And I apologize. If you have one more question, we're about 10 minutes late for the departure time.
One more question. I'll be
Please.
brief, Mr. Chair. So, who is authorized to sign off on paperwork when a child is in foster care and they need services? Is it your department? Is it CYFD? Do you have a joint approach?
Mr. Chair, Senator Tobiason, I think I would love to get back to you on that. We don't sign off on anything, but we are available. We work very closely. We're co-located in many of the offices around the state. But I would like to follow up with you and make sure that I'm giving you the exact correct response on how that happens.
Wonderful. Thank you, Mr. Chair.
Great. Thank you very much, Senator. Thank you all very much. Thank you, Madam Secretary, and we'll look forward to staying connected. Okay, we're going to turn it over to Director Salih. He'll get us on the bus, and we'll go from there.
If you want to head out the west doors, there's a air-conditioned charter bus waiting for us. It'll take us down to the Santa Teresa Jetport for a ribbon cutting for a capital outlay project that you've helped fund. Then we will head over to the racetrack and have lunch. And here, you can leave everything here. Staff will take care of any notebooks or handouts and stuff, so take your personal things.
Mr. Chair.
And then we'll have lunch and a couple of panels, and then a tour of the border where we'll stay on the bus but see it, and then a very nice evening reception and dinner at Ardovino's in Sunland Park.
If we want to drive to the location, and then we can hop on the bus with you at the jetport, or do we need to go on the bus to get to the jetport? Could we do that? Okay. We could drive down there? Okay.
It's about a 45-minute drive down to the jetport.
Okay. Do we have the address for it? Do we have the address for the jetport?